trust that each one of you are absolutely fine. So obviously, we would love to know actually what we are going to start. In fact, in today's this particular session, so we have decided to pick up a very simple topic, that is depreciation, correct? So we are going to start today with the depreciation. Depreciation accounting, this is the chapter which we are going to start today, as I said. So let me first of all write the title as usual, correct? So depreciation accounting, not a very what we call tough part. Remember one thing we have covered in this chapter, not only the questions of the chapter depreciation, but accounting standard, that part of accounting standard which deals with depreciation, even those questions we have incorporated in the study material which we have sent, and of course we are going to cover everything, whatever we are sending you. So depreciation accounting, correct? So accounting for depreciation, let me first of all write the title. Accounting for depreciation, this is the chapter which we are going to do and start now. Accounting for depreciation. You can expect a 4-mark question from this particular chapter, not a very high profiled question, but you may have one question definitely. Accounting for depreciation, correct? Now, as far as accounting for depreciation is concerned, it looks pretty easy. It seems that we are very well familiar with all the what we call facets of this chapter, because we have been doing this particular chapter right from our class 11 days, isn't it? So the feeling creeps in. At the same time, to be very honest with you, I'm not going to say that your feeling is wrong. Absolutely, chapter is not tough, neither tedious nor complicated, pretty simple. But in spite of that, definitely when we are at this particular level, we have to equip ourselves with a little bit more. So just to actually go through, for that little bit more, we are covering this particular chapter here. So let's start the what we call chapter, but in a entirely different what we call manner, correct? So accounting for depreciation, before I let you know what exactly the depreciation is, what are the causes, the factors of the depreciation, what are the objectives, correct? Before I talk about amortization, depletion, and what we call dilapidation, there are many other words. But before what we call move over to that particular territory, let me actually make it absolutely clear over some important facets which definitely will become very handy for you later on to actually grasp the what we call this particular chapter. So here we go. Before we start the particular chapter, as I said, let me actually begin it this way. It's a rough work. If you want to write, you can. Otherwise, you need not require, because later on I'm going to make you write everything. These are the things only to make you understand some important facts, correct? First of all, you must understand that fixed assets, whenever we use the word fixed asset, correct? Fixed asset comprises of 3 types broadly. One, we may say tangible fixed asset, as each one of you are very well aware of this. Tangible fixed asset, isn't it or not? Tangible fixed asset. Tangible fixed asset, which can be seen, which can be felt, which can be what we call pushed here and there. Suppose this particular podium is there, it's a fixed asset, correct? So, and it's a tangible fixed asset. Similarly, there are intangible fixed asset, as you know. Intangible fixed asset. It's a rough work, don't worry about that. Even if you do not want to write anything, you have the liberty to do so. Intangible fixed asset. Besides, there are some fixed assets in the form of, we call it natural assets, correct? Natural assets. Have you heard about it? Yes, sir. And some of you are telling no, sir. No problem. Whatever type of fixed assets are there, plant, machinery, building, all these are tangible fixed assets, furniture, fixtures, correct? Intangible assets like copyrights, like goodwill, like patents, like trademarks, like technical know-how. Even these are intangible assets. First of all, you should know the meaning of asset. Asset, no doubt you have been hearing about that right from your class 11 days, that assets are the resources which are controlled by an enterprise and which are capable of fetching returns for more than 12 months. Generally, such resources are assets for an enterprise. It is very important to understand that I have developed a technique. That technique technically is termed as intangible asset or fixed asset. correct? It is intangible fixed asset. Number one, I have developed this technique, that means I have got the control. Till I have got the control, that asset will definitely is going to bring returns to me, isn't it or not? Of course, for quite a long period of time. So it is very important to understand that assets are the resources which are controlled by an enterprise and which are capable of fetching you returns for a period at least exceeding 12 months. Now, after having a look over the asset, we need to know the fixed asset before we go through the what we call grounding for depreciation, correct? Let's have a look over all these concepts. Now, tangible fixed asset, intangible assets, I have already mentioned out. That is trademark, copyrights, goodwill, patent, technical know-how, techniques, designs. All these are intangible sort of assets which can't be seen, but they are capable of bringing you return, but controlled by your enterprise. Natural assets, like minerals, like oil wells, like gold mines, coal mines, all these are natural resources. Now, natural resources, when I say oil well, so it means oil fields which are capable of producing oil, but they have some limited capacity to produce. For example, there is an oil field which can produce maximum 100 lakh tons, correct? The moment I am going to extract 10 lakhs, the utility of that particular oil field will decline definitely. So all these type of fixed assets, first of all, you should be very well aware of. And further point is that due to some or other reason, we know with the passage of the time, value of all these assets will fall. We know value. When I say value, it means service capability of the assets. When I purchase a particular fixed asset, it is going to serve me, SERVE. It is going to provide some services to me for a pretty long period of time, say 10 years, 5 years, 15 years, isn't it or not? So, but the moment I am going to use that particular fixed asset, correct? And to be very honest with you, even if I am not going to use it, if I will keep it as it is, but with the passage of the time and the inflection of the time, the value of that particular asset will fall. Correct? As we know, actually, value of the fixed asset falls due to wear and tear, or technical obsolescence, or technical improvements, isn't it or not? So due to some or other reason, the value of all types of fixed asset will definitely fall. Correct? Value shall fall. We know the value of all fixed assets falls either due to wear and tear, or due to inflection of time, or because of technological what we call improvement. Correct? Value shall fall. Anyway, we are not going to look over the causes. Simply what I am trying to tell you is that fixed assets are of three types, broadly three types, correct? Tangible, intangible, and natural resources. And all these sort of what we call natural resources will lose their value due to some or other reason. Now forget for a while whatever may be the reason. We need not require to unnecessarily put up that into our head. Right at this moment, you should be concerned with only one thing, that value shall fall. Now, when the value of intangible asset falls, it is known as depreciation. Correct? The fall in value of tangible fixed asset is known as depreciation. We are aware of it. In fact, very well aware of it. It is known as depreciation. Likewise, when the value of intangible asset falls, even it is a sort of depreciation, but rather than naming it as depreciation, we call it as amortization. We call it as amortization. Correct? We call it as amortization. That is important to understand. When I say particular asset is amortized, you must understand that I am speaking in the context of what we call an intangible asset. Decline in value of an intangible asset is known as amortization. Similarly, decline in value of natural assets, instead of calling them either as depreciation or amortization, instead actually we use the word depletion. Correct? We use the word depletion. Depletion. So depletion is a word generally which is associated with decline in value of natural resources. Is it clear to you? First thing first. First of all, you should bear this particular thing into your mind. In this chapter, when we will use the word depreciation, correct? When we will use the word depreciation, you must understand that Depreciation is the word which is connoted, which is related only with tangible fixed asset. Correct? Second important point is that now depreciation is covered by AS10. Depreciation is covered by, you need not require to write at this moment. It's all a rough work right now. Depreciation, but still if you desire to write, it is entirely up to you. Depreciation is covered by AS10, as I just told you. Correct? Earlier it used to be covered by AS6. In fact, there was a separate standard for depreciation, but accounting standard AS10, technically speaking, it deals with property, plant and equipment. Property, plant and equipment. The title of accounting standard AS10 is property, plant and equipment. Now what is property, plant and equipment? Property, plant and equipment, you must understand, because all these things, being a professional level student, you should be in the know. Property, plant and equipment, PPE, is nothing but it stands for tangible fixed asset. It stands for tangible fixed asset. Correct? So we may say AS10 deals with tangible fixed asset. Are you getting my point? And because depreciation is related with tangible fixed assets, so it was thought better to cover the concept and gamut of depreciation under the fold of AS10. So that is one part. But we know that decline in value is also associated with intangible assets and natural resources. Both these two items shall fall under AS26. AS26 encompasses with amortization or what we call intangibles. So that means when we use the word amortization, technically all intangible assets and directly indirectly natural assets are associated with what we call AS26. So their decline we can say technically is covered by AS26. Very important also to understand, when we say fall in value, so fall in value is nothing but it is a loss. Obviously, if I have purchased a particular asset and its value declines, let us say I bought a car today for, let us say, 40,000. I did not use the car for next 6 months. Would the car after 6 months fetch me 40,000 in spite of the fact that it is absolutely as it is at it was bought? Even though I didn't use the car and it is absolutely in the same condition, correct, as it was when I bought it 6 months ago. But in spite of that, after 6 months, it cannot fetch me the same value, because even with the passage of the time, the value declines. Are you getting my point? So quite obviously, let us say after 6 months, I sell the car due to some or other reason, but it could fetch me only 35,000. 5,000 is a loss, decline in value. Now this decline in value is a loss. Whether this decline in value is in the form of depreciation, amortization or depletion, it is value in fall in value. Value fall is a loss. You must understand that. That means when I say fall in value is a loss, it means depreciation, amortization and depletion, because these are losses. These are debited to P&L account. Correct? So fall in value, that means intentionally I am writing fall in value. Fall in value, that is either depreciation or amortization, shall always be debited to P&L. Why, I need not require to tell you. Correct? It will be debited to P&L. Is it clear to you or not? First thing first, these are the normal fundamental things, but very important. Being a professional student, as I said, you should be aware of all these things. Now very important, we know that what exactly the depreciation, I need not require to elaborate upon it time and again and again and again. But we must understand, when so often we use, and we have been using it since our class 11 days, as I said, correct? But I have found through my experience, actually almost 25 years in the trade, that students are still not in the know of real sense of depreciation. So let's have a look down over there here before we proceed with further things, correct? Say, what should I write? Let us say this is the date 1/1, okay, 1/4/2020, correct? On this date, our company, my company, whatever the name of the company, correct? Purchases a machinery. Purchases a machinery on this date. We purchase the machinery and the price of the machinery is, let us say, rupees 50 lakhs, or let us say rupees 90 lakhs for simplicity's sake. The price is rupees 90 lakhs, correct? I purchased it on this date. Well, let us say we are concentrated in city X, correct? Our company is in city X and we bought the machinery from a far off place which was located in city Y. We are in city X, we bought the machinery from city Y. So machinery will not automatically come to our place. We will have to do some efforts to bring the machinery to the site of our concern, isn't it or not? For that we may have to incur some expenses. So let us say we incurred some expenses in bringing the machinery to our location, correct? So some expenses were also incurred. Expenses incurred, let us say rupees. When I say expenses, it means expenses in connection with bringing the machinery to our site or location, correct? Say expenses are worth rupees 10 lakhs. Very simple, no problems. Now this is the accounting year. This accounting year, because it is starting on 1/4/2020, quite obviously it will be over by 31st of 3/2021. This is the end of the accounting year, correct? But before we move further, this is the present situation. Now try to understand the further gamuts. When we bought the machinery, the management of the company quite obviously is going to estimate the life of this particular machinery. If suppose we are going to spend 90 lakhs along with 10 lakhs further, obviously it's not a very small or bigger amount. So definitely our management team is going to actually put lots of effort and sweat it out in estimating the useful life, that is the time period for which this particular machinery can be economically what we call beneficial to us. That is what we mean by the life of the machinery. Whenever we would say life in this entire chapter, correct, it would always mean economic life. Economic life means the time period for which machinery can be economically beneficial to us. Economically beneficial to us means it is helping our business in what we call production of goods and services, or in some or other way around. But it is helping our business operations. Now, we bought the machinery on 1/4/2020. Don't let it escape out of your mind. Correct? This is the date. Our management, which was which was comprising of very high intelligent guys, they estimated that this machinery will be useful, keeping into account the various factors, competition, our production needs, and many other factors. They estimated that this particular machinery would be helpful at least for the next 10 years. So useful life is now estimated. The accounting year is ending on accounting year is starting from 1/4/2020. First accounting year will end here, second will somewhere end here, third, fourth, fifth. First, second, third, fourth, fifth, sixth, seventh, eighth, ninth, and 10th. Let us say 10th accounting year is ending here. 31/3/21, first year, 22 second year, 23 third year, 24 first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, and 30th. Now the point here is that we have estimated the useful life. So that means whensoever fixed assets are bought, whether tangible, intangible, correct? Generally, because we are referring to depreciation, it means directly or indirectly we are talking about tangible fixed asset. But it is equally true of what we call other assets, other type of fixed asset. Asset in this particular chapter shall always stand for fixed asset. Even in case by the slip of tongue, if I would say, let us say assets instead of fixed asset, you construe it as fixed asset, correct? So useful life. So we have estimated that useful life, we means generally if a concern or organization would what we call acquire fixed asset, they are going to definitely in practical life have a look over the useful life. You should understand the meaning of useful life. The time period for which this particular asset can be used economically by your concerned business or institution or organization. Useful life. For simplicity's sake, we have presumed that useful life of this particular asset is 10 years. Obviously, the useful life will end here. Now, when the useful life of the asset expires, after that, there are two possibilities, as you know. We have presumed that useful life of the asset is ending down over here. So after that, there are two possibilities. One possibility is that asset is absolutely valueless. Asset is absolutely valueless means this particular asset will not fetch me a single penny in case if I were to sell this particular fixed asset after the end of the 10th year or useful life to somebody else. It is not going to fetch me a single penny. So one possibility is that after the end of the useful life, the asset is not having any value. And one possibility is that, as you know, asset may have some value, may have some value, may have some value, may have some value. This is another possibility. It may have some value. Say after the end of the 10th year, of course, this particular asset has gone past its useful life now. We cannot what we call get any benefit for our business, but in spite of that, asset may have some value and some other firm may be able to use it for their needs. Or I can simply sell this machinery to a scrap dealer who can use the what we call iron or nuts or bolts of this particular machinery for different purposes. So in that case, machinery may have some value. That means it is capable of giving you some return. So two possibilities exist after the end of the useful life. Now if asset is not having any value, we say residual value is 0. That means after the end of the life, we talk about the word residual value. I will write the full form later on. Right now I am simply writing RV. And moreover, you are very well aware of all these terms. So after the end of the life period means useful life period, the value may be 0 or asset may have some value. Is it clear to you or not? Correct. Fine. In this particular question, we presume for a while that after the end of the life value is 0, there is no harm in it. Correct? Now you have bought, now from here on you need to pay some attention. I don't want you to go from what would go in a normal, usual manner, methods of depreciation or something like that. First, you must understand the realities of this particular chapter in the light of the practicality. Correct? Pay attention here. Now, I will ask you some simple question. I am simply asking you one thing. Could you tell me the cost of fixed asset, cost of this property, plant and equipment, that is machinery? What is cost? Cost means the price, purchase price. Whenever we say price, it means purchase price. The purchase price is 90 lakh, of course. This is the price. But cost will include all those expenses which you have incurred in what we call bringing the machinery to your site and installing the same. That means all those expenses incurred in bringing and installing the machinery will form part of the cost. So logically, cost of this particular machinery shall be termed as what? 100 lakhs. Cost comprises of purchase price plus expenses. This is one thing you must understand. Is it clear to you? Second important point, I just want of you to let me know useful life. What is the useful life of this particular machinery in this case, if I were to toss up this particular question? Sir, useful life is 10 years. In fact, this is the life you have pursued. Fine. Third, residual value. Residual value. What is the residual value of this particular machinery in this case? I would love you to let me know. Residual value could be 0 or could be of some amounts. We have presumed residual value as nil in this case for simplicity's sake. Correct? It means whenever you are going to buy a fixed asset, correct, tangible fixed asset, you need to know very well all these three things. Later on we will see these are considered as the pertinent, important, significant factors, correct, in computation of depreciation. Now, right now we are simply not talking about depreciation. I am going to tell you something very important. Just pay attention. Now pay attention. Suppose under the impression that my company purchased plant and machinery for rupees 100 lakh in this case, correct? My accountant, who was a novice actually, so many a time he sleeps and he passes some entries which can really give you hiccups. Our accountant, he was lost somewhere, and the moment he heard 100 lakhs spent for purchase of a machinery, what entry he passed? See here. First you let me know what entry you would have passed. Sir, we would have passed plant and machinery account debit to bank account. Very good. This should have been the entry. You have spent 10 lakhs. Sorry, 100 lakhs. 90 plus 10. Even the expenses which you have incurred in connection with purchase of what we call asset, fixed asset, will be capitalized, will be debited to plant and machinery, correct? So plant and machinery account debit to bank account, this should have been logically your entry. However, my accountant or our accountant, what entry he passed? He thought himself as the most superior breed in this human world, and he looked at us as if we do not know anything, and he passed it very graciously, this entry. See here, he passed this entry: expenses account debit to bank account. Oh my God, expenses account debit to bank account. This red pen is not working. Okay, I will take this one. Expenses account debit to bank account. This is the entry he passed. He thought we have committed the mistake by passing this entry. So he puts his point of view further. Expenses account debit to bank account. Oh my God, 100 lakhs. This is our superior accountant. He says entry should be this one. And not only this, he elaborates further. After passing this entry, at the end, this entry of course will be passed on the date of the what we call, on the date when we made the transaction, and we made the transaction on 1/4/2020, correct? And our accountant first passed this entry, and at the time of finalization of account he is passing another entry. Entry is profit and loss account debit to expense. This entry will be correct provided this entry is correct, correct? Profit and loss account debit to expenses account. So see our accountant, how intelligent he is. He is thinking that we have passed the, he is considering this one as the what we call incorrect entry, and he thinks these two entries are correct entries, and he is letting us know the reasons behind that also. I will let you know, don't worry about that. He passed these two entries and he made us understood. Instead of passing these two entries, he claims, our accountant is claiming, actually there is no need to pass the entries, and we are looking at him absolutely bemused and absolutely perplexed. There is utter confusion in our mind, but our accountant is going on. Logically, two entries need to be passed, accountant is saying. But why to pass these two entries? We can combine these two entries, cut expenses, chop expenses, correct? So we are left off with P&L account, debit to bank, fine. Logic is okay. Profit and loss account, debit to bank account. Now, accountant goes further, and we are looking at him as if he is the eighth wonder. 100 lakhs. This is what our accountant is doing. Oh my God. Profit and loss account, debit to bank account, he says. When we are purchasing a machinery for 100 lakhs, he is coming out with his tremendous logic that because we are spending 100 lakhs, correct? So we should, it is an expense for us, so we should debit profit and loss account by 100 lakhs and to bank. We are absolutely speechless. And the accountant is going on without any break. He further says, now we will prepare the profit and loss account. He started preparing the profit and loss account. And in the profit and loss account, he says, because P&L account is debited, we will have to write here to bank. Actually, bank is nothing but expenses here. 100 lakhs. He says 100 lakhs will be debited to P&L. And then he moves over to the balance sheet. But he doesn't write, but he did not write anything in the what we call balance sheet. Reason? Because the entry which he has passed, in this entry there is nothing which can be written in balance sheet except bank. Now the point here is, suppose if we go by the version of the accountant which looks pretty amusing and of course pretty incredible also sometimes, that how the human brain could think on such lines. But anyway, our accountant, he tells that because we are spending, cash is moving out, it's a loss to us. Every cash which is moving out of the business, he is considering it as a loss, and he tells that entry should be like this. And if we go by his version, what will happen? Our profit and loss account will get a debit of rupees 100 lakhs in the first year. Our profit and loss account is getting what we call debited by 1 crore, 100 lakhs. On the other hand, in the balance sheet, even though we are having some plant and machinery, but our balance sheet is not reflecting that. So that could be a disaster. Are you getting my point or not? This way financial statements cannot be prepared. As you know, this particular, if we will go by the version, this version, it will completely what we call underestimate our profit earning capacity in the first year, and beside it will also give a very what we call sorry figure as far as balance sheet is concerned, because in spite of having an asset almost worth rupees 100 lakh, it is not being reflected over here. So you can see the importance of depreciation accounting. This is the point I just wanted to bring to your notice. We cannot go by this particular version which I have written here, red pen. It is absolutely wrong. So what we need to do then? Point is how we can, what we call, give it a picture which will conform to the accounting norms and procedures. As you know, we come back to this one, the blue entry, plant and machinery to bank. This should be the entry in the first year, correct? No doubt about that. No doubt it is an expenditure. But in business, every amount, every outflow cannot be debited to profit and loss account. If the outflow is of such nature that it is going to bring the benefit only for 1 year, then it can be debited directly to P&L, no harm. But we know this particular asset or this outflow of 100 lakh which has resulted in a fixed asset is going to bring the benefit to our concern for the next 10 years. So logically, this outflow of 100 lakhs should be debited to each of 10 years profit and loss account and not to the P&L of the first year itself. Are you getting my point or not? What my point is, try to understand this thing. We know this 100 lakh is an expenditure, no doubt about it. It's a capital expenditure resulting what we call in plant and machinery fixed asset. There is outflow of 100 lakh, but at the same time we are having 100 lakh worth of asset. No doubt this is an expenditure, it is a capital expenditure. Because it is going to fetch us return for a pretty long period of time, we cannot debit entire 100 lakh to the first year's profit and loss account. That will be absolutely absurd, isn't it or not? And it will be very, very ridiculous. We know that this 100 lakhs worth of expenditure or this 100 lakhs worth of asset is going to fetch us return for how many years? 10 years. How many years? 10 years. 1, 2, 3. So this particular 100 lakhs is giving you a service, a benefit for 10 years. Logically, as per the accounting practices and as per matching concept, correct? When you are getting a benefit for 10 years, so obviously, and every year of first 10 years, you are getting some benefit. So every year must be debited by something. That is matching concept. So 9th year, 10th year. For 10 years, you are getting a benefit. Logically, or first of all, illogically, we should not go by the version of this novice accountant. Rather, what we need to do, we need to debit to profit and loss account some portion of this expenditure to first year's P&L, then to second year's P&L, then to third year's P&L, then to fourth year's P&L, and likewise. That is what my point is. That means P&L account of each of these years must getting some brunt, must get some debit. And when we adopt this approach, it is nothing. It is known as allocation of cost. It is known as allocation of cost. We will see two important definitions of depreciation. One definition says that depreciation is a gradual decline in value of fixed asset due to the reasons which I told you earlier, wear and tear, obsolescence, or technological improvement. Important point is that depreciation means decline in value. This is one definition. And second definition, correct, which is given by IAS4, International Accounting Standard AS4, which states that depreciation is nothing but allocation of cost. But how these 2 points are reconciling? One says it is decline in value, other says depreciation is nothing but it is allocation of cost. Now you try to understand this point, and once you are able to understand, then you will be able to grace the beauty of this particular chapter. I don't want you to actually have what we call a run-of-the-mill sort of what we call coaching. No, nothing like that. So you need to understand the important facets. See here, one definition is decline in value, gradual decline in value, decline in value. This is one definition or one version of the definition. Another version given by International Accounting Standard AS4, it says that depreciation is nothing but allocation of cost. Now you try to understand the point. And once you understand that, you will understand the meaning of these two definitions, and you will find there is similarity. Allocation of cost. Right now it is not looking that way. See here, we know that when we are going to buy or purchase a fixed asset, its value definitely will fall with the passage of time, due to wear and tear, due to obsolescence, due to technological improvement, whatever it might be, whatever may be the reason, but value will definitely fall. Value will fall. But by how much the value is falling? The point is this. How we will estimate that? We know that value will fall. But what monetary amount we should assign to it? That is the important point. Correct? Just hold on. अरे बना दूंगा तो टाइम लगेगा तो कौन करना है कल को भी करना है हाँ देख सीएस का तो अभी नया कोर्स बनाना है ना नए वाले के बाकी टॉपिक कहाँ हैं तो जो चेंज हुए ना तो सीएस का बनाना पड़ेगा इश्यू सीएस दे दूँगा अब वही रात को ही दे पाऊंगा अब तो 4 अपलोड घर में करूँगा तो घर में मेरी स्पीड भी तो इतनी नहीं है वो कल सुबह ही हो पाएगा तो खाली नहीं अभी बाहर ना कल तो क्या दिवाली का टाइम है ना फेस्टिवल का तो जरूरत है तेरे अकाउंट में आ जाएंगे सुबह तक उसका सर जो मेरा शेयर है लगाओ extremely sorry. So decline in value. I was trying to tell you when we say every purchase of fixed asset we know after at some or other point of time will lead to decline in value of these fixed assets. This is definitely one part of the definition. It is quite true. But when we say decline in value, by how much? That is the big question, in fact, $1 trillion question. So decline in value is there is a loss, but we will have to give it some monetary value. How that monetary value is given, that is depreciation accounting. So depreciation definitely is what we call decline in value of fixed assets. And depreciation accounting in nutshell, in brief, is nothing but allocation of cost. That means that decline in value is being given some monetary value. How that monetary value is given, that is the important point. Correct? So what my point is, try to understand. I spent an amount of 100 lakh. I am going by the version of, let us say, for a while with that novice accountant. Because he also thought that it is an expenditure. No doubt it is an expenditure, it will lead to an outflow of funds. But as you and I both are aware of this particular fact, that every outflow is not an expenditure. Correct? Every outflow is expenditure, but every outflow cannot be debited to P&L in the first year itself. Such outflows which will help you get benefit for a period exceeding what we call 12 months, definitely those outflows will be debited to P&L in a rational and systematic manner. In fact, depreciation accounting is nothing but allocation of cost in a systematic manner, in a rational manner. So how we are going to debit 100 lakh to P&L in these 10 years, for that management will have to do again lot of efforts. Correct? That is why it is said that allocation of cost, depreciation is allocation of cost in a systematic and rational manner. I will proceed further. See here. We know that we have spent 100 lakh rupees, but this 100 lakh is going to give us service for 10 years. So obviously these 100 lakhs will have to be debited to 10 years profit and loss account. We will debit some portion to P&L in the at the end of the first year, in the second year, third year, and we are going to debit some amount to each of the first 10 years. No doubt about that. But how much amount? First thing first, when we are going to debit some portion of this cost, it is known as allocation of cost. Now you are allocating the cost to the different P&Ls of different years, correct? But how that allocation is done is, now the rule says, or the high profile definition says, correct? It says that we need to be systematic and we need to reflect rationality. We need to be systematic and we need to be rational. What does it mean? Say here, we presume this machinery which we bought, we presume that it will deliver, let us say, 500 lakh units for simplicity's sake during the 10 years. I am buying a machinery to produce goods and services. Our management is of the opinion that once they are going to purchase this particular machinery, then in the next year, this machinery, in the next 10 years, this machinery has the capability, that means during these 10 years, this machinery is capable of what we call producing 500 lakhs units of the product which your concern is manufacturing. So, our management now further estimates that each year we may need 50 lakh units. Each year we may need 50 lakh units. That means there is demand for our products. So our management is of the view that each year we will produce 50 lakh units with the help of this machinery. Now let us say at the end of the first year we are able to produce 50 lakh units. What was the total capacity to produce of this particular machinery? That was 500 lakhs. Rationality says here that you should not be irrational first of all. Rationality here means you have to think before leaping. You should not what we call use an imaginary figure. You should not think of a figure that in the first year we will write off depreciation 5 lakh, in the next year 8 lakh, 10 lakh. This is an irrational way. Neither there is any system in it. So standard says, or in fact the definition says, allocation of cost in a systematic and rational manner. What does it mean? Rationality says that when the total capacity of this machinery is 500 lakhs and you are able to produce 50 lakhs, and in fact you will be producing 50 lakh each year in each of these 10 years, it means every year you are using how much? That is 1/10 of the capacity, isn't it or not? Every year you are using 1/10 of the capacity. See, total capacity is 500. If I will compute 1/10, it will become 50 lakhs. That means each year we are using 1/10 capacity of the what we call this particular machinery. So rationality suggests that each year we should write off 1/10 of the cost, isn't it or not? You got my point or not? So when we say it's a decline in value, so now we are able to understand that decline in value in monetary terms actually is 10 lakhs. So we may say by the end of the first year, this machinery has come down by 10 lakhs. It also means that we have taken a benefit of 10 lakh out of 100 lakhs. Are you getting my point or not? So because there is a decline in value of this machinery by 10 lakh, it is a loss to you, no doubt about that, and that loss will be debited to P&L. First of all, I just wanted to bring to your mind, because I have seen through my experience, a student never knows the meaning of this systematic allocation. So you must understand these wording, especially after having reached at this particular level. There is no point, as I said, in going by what we call run-of-the-mill, what we call studies. So this is the point which you need to understand very well. What exactly decline in value stands for, what exactly allocation of cost stands for. Both these are interrelated terms. Assigning a monetary value to the decline in value is nothing but your allocation of cost. So that is why what we call, there are two definitions, two major broad definitions of depreciation. Is it clear to you or not? So basically allocation cost, you can say, is a part of depreciation accounting, whereas decline in value is a theoretical, what we call, analysis of depreciation accounting. And allocation of cost is a practical version of depreciation accounting. This way around we can conclude this particular what we call discussion. Is it clear to you or not? Have you been able to understand the point which I just wanted to bring to your notice? So now we shall move further. Still the story is not yet over. See here, we know that we purchased the machinery. Well, in the beginning of the first year we purchased the machinery, and our entry as per your and mine version should be fixed asset account debit to bank account. You can name the what we call asset also, that is plant and machinery, to bank account. And we know that total cost is 100 lakhs. Is it clear to you? This is 100 lakhs is the total cost. And we know that when we are going to reach the end of the year, at the end of the year, we are going to have some decline in value. And we will now assign it a monetary value. And through a rational thinking, rationality means after a lot of discussion, after a lot of thinking, you have decided on some concrete basis that 1/10 is the appropriate figure to write off the cost. So by 1/10 the value is declining now, it means, correct? So when value is declined, that is known as depreciation, because we have to name it. So we have given it a name. Decline in value is named as depreciation. So when we will give depreciation, the entry will be depreciation account debit, no doubt about that. Depreciation is a loss, it will be debited. Why it is a loss? Because value of fixed asset is declining. When value of fixed asset declines, we are going to give it a credit. Value 1/10 is declining by the end of the first year. This is your entry, correct? The entry number 1 will be passed in the beginning of the year, because when you acquire the what we call fixed asset, and at the end of the accounting year you will pass this entry. Besides that, one more entry you will have to pass, because this depreciation is a loss. It must be reflected in the P&L also, because if you are not going to reflect in the P&L, your profit will reflect an exaggerated amount, correct? So depreciation is a loss, so your net profit must be after this loss. So 10 lakh worth of depreciation now debited to P&L. Actually you can combine entry number B and C. If you will combine entry number B and C, as we know, depreciation shall get cancelled. We will be left up with P&L account debit to fixed asset account. Well, after the first year, we have reached the correct position now, correct? The accountant, our novice accountant, made a horrific situation, and we are trying to resurrect it, correct? So logically, what should have been reflected after the first year, if you would have done everything in a correct manner? Here, as you can see, 10 lakh must have been reflected. This is your P&L account. Besides, your financial position, that is balance sheet, should have reflected this way around. Fixed asset 100 lakhs, and see in the second entry you have written depreciation to fixed asset, so less depreciation, that is 10 lakhs. So we may say depreciation accounting helps us in number 1, assessing the correct amount of profit. Besides, it also helps in what we call assessing the correct financial position. Isn't it or not? So this is the correct what we call P&L. This is the correct what we call your financial position. So that is why the significance of depreciation accounting is so high. In order to have correct financial position, we need to have correct depreciation policies, very sound depreciation policies. So that was the reason why our accountant was absolutely wrong and why we are absolutely correct. Is it clear to you or not? These are very fundamental aspects which I actually talked about in this particular session. But in spite of that, at least we must have gained something. At least now you are very well aware of at least these terms: allocation of cost and value, decline in value. As I said while leaving the last one, that when we are going to meet you in the next one, we shall have first a look over the theoretical aspect before we move over to the practical part. So here we go, right along with me. I have written depreciation. So I'm trying to actually write the definition which I did tell earlier. Depreciation signifies gradual. Depreciation signifies gradual. Gradual means slow, steady. Gradual decrease. Gradual decrease in the value of correct, of fixed asset due to wear and tear. Wear and tear technically means constant use. Wear and tear, because when we use an asset regularly, it gets worn out, it gets torn out, correct? Wear and tear, comma, obsolescence. Obsolescence, as you know, means outdatedness. You have purchased a mobile today, and after 1 month, similar sort of mobile comes with some extra features, correct? So obviously the mobile which you are having in your hand will be considered as what we call that is outdated in comparison to the one which is now in the market, correct? So obsolescence. Or technological improvement. In fact, obsolescence is related to technological improvement. Technological improvement. So, this is what we actually talked about earlier. Then you also should be aware of this particular fact that depreciation in fact has some terms which are similar to like this. For example, we did talk about amortization. Do you remember? In the last session, we talked about depletion, and we are going to talk about again. So just write along with me terms. A, amortization. What is amortization? Decline in value. Decline in value of intangible assets. Decline in value of intangible assets such as patents. All these are intangible assets. Patents, copyrights, trademarks, isn't it or not? Trademarks, technical know-how, trademarks, technical know-how. Technical know-how means technique. Goodwill, etc. So their decline is considered as amortization, correct? Similarly, yet another term was there, that is depletion. D-E-P-L-E-T-I-O-N, depletion. Depletion is related to decline in value, related to decline in value, decline in value of, what did I tell in the last session? Value of natural resources such as natural resources such as oil wells, isn't it or not? Quarries, 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 sand pits, SAND, sand pits, mines, gold mines, coal mines, etc. Actually, all these assets are also termed as wasting assets because they have got limited resources. The moment we are going to extract something out of what we call all this, obviously their quantity will decline, their capacity to produce will decline, correct? So the reduction in value of what we call natural resources, instead of what we call calling it as depreciation, we actually refer to it as depletion. Is it clear to you or not? Nature. When I say nature, it means nature of depreciation. In this chapter, we are talking about depreciation, nature of depreciation. Term depreciation, comma, in strict sense, is applicable to plant, that means tangible fixed asset, plant, buildings, equipments, furniture, vehicles, tools, that is tangible fixed asset. In a strict sense, depreciation is related to fall in value of tangible fixed asset, correct? Tangible fixed assets. We know that it's a gradual fall. Gradual means the fall is not at once or sudden. With the passage of the time, the more we are going to use it, the more the time period will elapse, the greater will be the fall in value. So we call it what we call gradual fall. Depreciation is a gradual fall in value. Because we are talking about the nature, so we have to mention it again. Depreciation is gradual fall in value. Gradual fall in value. And we have already seen why the value falls, correct? Fall in value. We are talking about the depreciation, so we should be aware of this particular fact that depreciation is a loss and debited or charged to profit and loss account. Depreciation is a loss and therefore charged to P&L. Therefore charged to P&L. It's a loss, so obviously you are going to charge to P&L. Correct? But how much? What monetary amount you are going to charge? Do you remember we talked a lot about this in the last session? That is known as allocation of cost. Correct? So, International Accounting Standard IAS 4 provides that depreciation is allocation depreciation is allocation of depreciable amount. Now what is this depreciable amount? Depreciable amount of an asset over its estimated life. Just wait. Extremely sorry for this sudden interruption. Actually, there was someone to whom I had to attend to. So, anyway, estimated life. So, these are the normal things, in fact, which we have already talked at length in the last session, if you remember, isn't it or not? So, in the last session, we did try to actually understand the meaning of what we call that is allocation of cost, and I also explained how it is related to what we call the definition of depreciation, which states that depreciation is basically gradual fall in value. So, gradual fall in value is assigned some monetary value, and when we assign, that process is nothing but allocation of the cost. So, now coming back. Why I'm making you write, because sometime I have seen in the examinations, these sort of questions also are asked 1 or 2 marks, so you need to be in the know. You need to be aware of. In the know is a phrase. Causes of depreciation. Now we have already explained the causes. Causes of depreciation. There are several causes of depreciation. But prominent causes are, sometime under the objective type question these things are asked. So one cause is wear and tear. I have already told you wear and tear means when we purchase assets, correct, we will use them. So definitely when we are going to use them, along with the time, quite obviously their value will fall, wear and tear. And sometime also wear and tear also means loss in utility, let us say due to negligent holding. And negligent what we call handling. You did not handle it quite well, so quite obviously its value will fall. So wear and tear, and sometimes there are vibrations, there are chemical reactions, on account of that also what we call value falls. So we call it wear and tear. Wear and tear will include everything. It will include fall in value due to use, it will include fall in value due to vibrations, mishandling, chemical reactions, due to damage also, due to accidents also, etc. Correct? One cause is wear and tear. Second cause, as I just told earlier, is obsolescence. Now, generally obsolescence means outdatedness. Obsolescence. Because of what we call technological improvement, quite obviously, when an improved version will come, the older version, the earlier version will become old and it will lose its value. Correct? So obsolescence. Obsolescence takes place due to technological improvement. Correct? As I gave you the example of mobiles. Then, third, effluxion of time. Effluxion of time means passage of time. Effluxion of time. Suppose you buy a car today and for the next 12 months you did not use it at all. That means car is as good as it was bought on the first day because you didn't use it. But in spite of that, that car cannot fetch you the same value which it did 12 months ago. So depreciation also takes place due to effluxion of time with the passage of the time, isn't it or not? So effluxion time, these are the what we call major causes. Effluxion of time is also known as what we call time element cause, correct? We talked about causes, then you should be aware of also with respect to, this is fifth topic, you can call it, characteristics of depreciation. In fact, we have already seen all these things. But I have a habit of writing, because suppose in the examination question comes characteristics, students unnecessarily get jitters. In fact, what you have written in nature, all those things will come over here, but in spite of that, you should begin this way round, that first of all, depreciation is loss and it is a charge against profit. Depreciation is a loss and charge to P&L. Charge to P&L means we write on the debit side of P&L, charge to P&L. This is one game. Depreciation indicates when we write salary on the debit side of the P&L, what does salary signifies? Salary signifies the payments which you have made to your employees. When you write carriage on the debit side of your P&L, when I say P&L, it will include trading also, correct? So when we write in the P&L carriage, it signifies the fare which you paid in bringing the what we call asset to your location, correct? Similarly, when you write depreciation on the debit side of the P&L, what does it reflect? Depreciation reflects decline in depreciation reflects decline in value or service potential POTEN, service potential of tangible fixed asset, TFA. Quite obviously, when we are going to use the asset, its service potentiality shall fall. That is nothing but decline in value. So when we write depreciation, it reflects decline in value, correct? Then depreciation depends upon factors such as, in the last session I did talk about that when your management is going to compute the depreciation, what factors it will consider. Obviously, the first one we are going to consider is cost. And you know the meaning of cost. That means cost is the one of the major factor. You will also consider what? You will consider the residual value. Cost means purchase price plus expenses. You will consider the residual value. If residual value is positive, correct, obviously your cost will get reduced, correct? You spend today this much and you are going to get back something out of the what after the end of the life of that particular asset. Quite obviously it means your cost will reduce. The difference of these two is known as technically net cost. You can, for simplicity's sake, you can say so. So depreciation depends upon the cost, upon the residual value, upon the useful life. These two elements, cost less residual value divided by useful life, is nothing but your depreciation. That means in order to compute the depreciation, you need to have these things in your mind. Depreciation is process of allocation. It is a process of allocation, as we saw in the last session. Process of allocation, that is the cost which you incurred today will have to be allocated to all those years in which this particular asset is going to be used. So that is allocation, it's the process of allocation. Correct? So these are the things which you need to know about. So these are the characteristics, in fact, important characteristics. Allocation of cost I haven't written. Since we are covering at this moment theoretical part, so you should also be aware of objectives. We did talk about, I took the example of that novice accountant. Do you remember? If we will go by his version, when he is debiting the entire amount in the first year to the P&L itself, after the end of the accounting year, we will find that in the balance sheet there is no asset, and our account and our profit was reducing by a very heavy amount. In that case, in that example, I think the amount was 100 lakhs. So objective, of course, there are, technically speaking, there are two major objectives. Objective number one is that objective of depreciation accounting to determine correct profit. What should be our correct profit? We need to know the amount of depreciation, because only after subtracting depreciation we will have the profit. To determine correct profits, one. Second, to determine correct cost. See, when you are producing an output, correct, you will have to estimate its cost, and accordingly you are going to set your selling price and keep some profit margin. But how the cost will be settled? For that you need to know actually how much you spent, correct? And what was the amount of your losses in producing that particular output. Accordingly, the cost of that output will be what we call determined. Because we are writing depreciation on the debit side of the P&L, indirectly it means we are considering depreciation as an element of cost also. Are you getting my point or not? So, to determine correct cost, we need to have the amount of the depreciation. Yes, please write. Written. To determine correct position of financial statement. In fact, you write balance sheet. Because in the balance sheet, you will have to write the fixed asset at cost less depreciation. Its book value must be reflected over there. So for that, you need to have depreciation. So depreciation is needed for all these things. And D, to provide for, one of the objective of depreciation accounting is to provide for replacement of fixed asset. Replacement of fixed asset. Replacement of fixed asset. This is yet another what we call objective. Now, many a time I have seen But before that, let me also write one more thing before I explain this point. To comply with the legal requirements, depreciation accounting is also needed to comply legal requirements. Okay, you should know all these things. Point is this also. Now, I will explain this point. How depreciation accounting will help you in providing for replacement of fixed asset, you must understand, because I have seen a student, they have just knowledge of what we call superficial knowledge, but they have done superficial study, in fact I was about to say, and what they should have done is to understand the concept the way it should be understood. Unfortunately, that is not done. So here, I will explain this meaning. See, and this is a very important aspect. Let us say, this is current year. If you want to write, you can. In this accounting year, whatever it is, correct? In this accounting year, let us say some transactions are like this: cash sales. This is the organization, and this organization in this year has these transactions. Cash sales, let us say 5 lakhs, or should I make 50 lakhs? Okay, 50 lakhs. Then expenses such as salary, rent, etc. Correct? Salary, rent, etc. Let us say 30 lakhs. For simplicity's sake, all type of expenses, selling and distribution expense, administrative expense, salary, I have taken only salary and rent. Then I have written here depreciation. This is one, this is two, this is another one. Here I have written depreciation, let us say 10 lakhs. Now could you let me know the entries? Could you let me know the entries of this? Yes. For cash sales, what will be the entry? Cash account debit to sales account. Obviously. If I will write this entry, what will happen? 50 lakhs worth of cash sales I have incurred. So this would be my entry without an iota of doubt. Isn't it? Now, I'm asking a very simple question. When I am writing this entry, and after the end of the accounting year, when I will prepare my final accounts, correct? Let us say this is my trading and profit and loss account. Trading and profit and loss account. Obviously, I am going to write sales over here, 50 lakh. We know cash account is not written in trading and profit and loss account. Cash account will come towards the asset side. Let us say this is the asset side of the balance sheet. We are concerned more only with assets. Let us say at this moment. Correct? So now, towards the asset side, cash is there worth 50 lakhs. Correct? Let us say I have paid salary and rent 30 lakhs. What will be the entry for payment of salary and rent? Logically, there are two entries. Entry number 1, salary / rent account debit to cash account. This is one entry. Of course, 30 lakhs, 30 lakhs. Then you are going to pass another entry. What will be this entry? This salary or rent which you have paid will be now debited to P&L at the end of the accounting year. Isn't it? 30 lakhs, 30 lakhs. My point is that I can combine these two entries. When I will combine these two entries, my net entry becomes like this. We will chop out salary and rent. We will chop out salary and rent. It is debited, it is credited, we chopped it out. So we are left up with profit and loss account debit to cash. So instead of writing these two entries for salary and rent, we can simply write profit and loss account debit to cash account. One and same thing. Correct? Are you getting my point? As per this entry now, I will have to write here to cash. I can write in brackets salary, rent, and let us say this amount is 30 lakhs on the debit side. Correct? Because I have written P&L to cash, so my cash will now fall down because cash is now getting credited. So by 30 lakhs, cash is falling down. So balance left in the cash account is 20 lakhs. Before we proceed, let me make it absolutely clear. If I am going to balance my P&L at this moment, what figure I am going to get? This is net profit before depreciation, because we haven't yet debited depreciation. There is a third transaction also. Net profit right now is 20 lakhs. This is before depreciation. But this profit will also be known as cash profit. This is known as cash profit. Many a time I have seen actually students are not able to actually grasp the real meaning of profit. There are two types of profit. One is simply profit and another one is cash profit. When we say cash profit, that means we have subtracted only such items in the P&L which are also reducing our what we call cash balance. Pay attention. When I pass first entry cash account debit to sales, it's fine actually, it is bringing in cash and we have written towards the credit side of what we call P&L. It's okay. Now we are talking about expenses. There are two types of expenses in accounts. One, cash expenses, and you must have actually heard about what we call all these things, cash expenses and non-cash expenses, in your cash flow statement too and in your financial management too. Correct? But we do not grasp the meaning of what we call cash expense and non-cash expense. That is the only problem. See here, logically, in a strict sense, expense technically means something which is reducing our cash also. If some item logically will not reduce your cash, logically it should not be written in the P&L. Logically it should not be written in the P&L, but in spite of that we write it, and we had been writing in fact. Isn't it or not? But why we do so? That's the important point. So here, when you pass this entry profit or loss account debit to bank, in fact, these are our cash expenses. You can see where first we are paying cash and then we are debiting it to P&L. Correct? So such expenses on account of which cash also gets reduces. All the expenses will reduce your profit, no doubt. But expenses which reduces our cash also only are termed as cash expenses. But there are some expenses in accounts which are written towards the debit side of profit or loss account, but they never result in what we call decline in cash. Such expenses are known as non-cash expenses. Why I brought this particular point here? To make you understand one important, significant part of this particular chapter. See, tomorrow when you are going to actually, after becoming professional, attend what we call interviews, such sort of things are going to be tossed up in front of you. So you should be in the know of all these things, as I keep on telling. So just pay attention down over here. So far, we have written only cash expenses, and technically speaking, this is my real profit because this expense which I have written here is also reducing my cash. Correct? Number one. Now just pay attention towards the third transaction. Depreciation. What is the entry for depreciation? Do we write depreciation to cash? We never write that. So that is why depreciation account ultimately is debited to P&L, because you have already passed earlier entry depreciation account debit to fixed asset, and now that depreciation is being debited to P&L account at the end of the accounting year. Now this depreciation, which is worth rupees 10 lakh in this case, see here, because we have debited it to P&L, first of all, why we are debiting? Because we know it's a loss. It's a loss in value. So in order to compute the correct profit, I will have to write depreciation, and in fact that is the reason in order to compute the correct profit, we write even non-cash expenses. See here, I have written here 10 lakhs. Obviously now my profit, which was earlier 20 lakh, is now left up with how much? Net profit logically is now 10 lakh. This is profit in accounts. This is profit in financial management, because financial management deals with cash profits. That's the point. But anyway, we are at this particular moment more concerned with what we call accounts. Point here is that when I wrote here what we call depreciation, it did not affect cash account. Any such expense which you are writing or putting up towards the debit side of your profit or loss account, and it does not what we call influence the cash balance, is known as non-cash item. First of all, you must understand that. Quite obviously, you may be quite keen to know actually, if cash is not flowing out of the business, why we are putting it towards the debit side. I have already told you, because one of the basic objective of depreciation, because we want to compute the correct profit. After all, it's a decline in value. So if we are not going to consider it, that looks a little bit ridiculous, isn't it? So point here is that we write depreciation towards the debit side. Now see here, logically there is a fundamental relationship. Logically, if your net profit, now this is your final profit, correct? Logically, if your profit is 10,000, your cash balance, your opening cash balance should now increase by 10. Should increase now by 10 lakhs by the same amount. If my net profit is 10 lakhs in the current accounting year, I earned 10 lakhs. So logically my cash balance, opening cash balance or the previous year's closing balance, which we do not know in this question, to be very honest with you, but suppose I presume my opening cash balance is 0. Correct? And in the current year, we have seen what is happening. 50 lakh worth of cash is coming in, 30 lakhs worth of cash is going out, but balance in the current year is now 20. That means our previous balance 0, now 20 lakhs. So logically, our cash balance is increasing by 20 lakhs. But our net profit is 10 lakhs. It means, see here, what we are going to do now, what the management is now going to do now. Management knows that cash is increasing by 20 lakh. It will set aside 10 lakh. 10 lakh worth of cash will be kept aside for what purpose? For saving purpose. Which type of saving? Because we know that after some point of time, that means after say 4 years, 5 years, 6 years, we may need another what we call this type of machinery, because after 7, 8, 9, 10 years, this machinery will become useless for us, because it has reached the end of its useful life. Suppose if I presume the useful life happens to be 10 years. So for 10 years, whatever amount of depreciation we have written here, same amount of depreciation has resulted in cash savings. Try to understand here. Suppose if I hadn't written what we call 10 lakh here, my net profit would have been 20 lakhs. Correct? Then it's fine, no problem. But now your net profit is increasing by 10 lakh, but cash is increasing by 20 lakh, because this 10 lakh you haven't subtracted from cash, and we cannot, because no cash is moving out right now. Right now it is not moving out. Are you getting my point or not? So when we write depreciation on the debit side, it is nothing, but it is a sort of what we call savings the management is creating, so that later on in future we have sufficient balance to replace this particular what we call asset. That means by writing depreciation here, when we write depreciation here, even we know that there is no cash is going out. In fact, writing of depreciation in a common layman's language, what does it signify? It signifies that out of this profit, you are setting aside for depreciation. In fact, you are setting aside, we write depreciation, but it means we are setting aside what we call 10 lakh for the future replacement of the fixed asset. That is why we have written that the point which I am explaining, that depreciation accounting also deals with provisioning, sort of what we call fixed asset. It helps in what we call replacement of fixed asset. I hope you got this particular point. Is it clear to you or not? That is why I keep on stress that we must not actually do only the superficial studies. We need to understand the things, because rest of the things are nothing complicated in this particular chapter to comprehend, because most of the things are already known to you, isn't it or not? So what we call, having taken a look over the initial concept along with some theoretical notes, now we move over to the important part. However, it is not very difficult, correct? So now we move over to the methods. So right along with me, methods of charging. So far today in this particular session, I haven't used the red pen. That looks a little bit amusing, isn't it or not? So before you think that it is amusing, let me pick up the right pen and start writing. Methods of charging depreciation. Methods of charging depreciation. Methods of charging depreciation. To be honest with you, there are lots of methods as far as this particular topic is concerned. There are lots of methods to charge depreciation, and problem is that we are following in fact AS10. However, AS10 actually clarifies only 3 methods. Anyway, before we move over to what AS10 says, let's have a look. So as far as methods are concerned, we can broadly classify methods as capital, or source of funds method. Capital or source of funds method. Sir, we haven't heard about it. That's why I'm writing here. Under this, generally following methods are adopted, that is sinking fund method. I have already told you there are lots of methods of charging depreciation. One is sinking fund method. Then another one is annuity method. Annuity method. Besides, there is one insurance policy method. Insurance policy method. Insurance policy method. As the name suggests, these are the methods under which generally what happens, either our capital reduces or we use business funds for the purpose of depreciation. Then second broad classification is time-based method. Time-based method. Time-based methods. Under time-based methods, one is fixed installment method. Fixed installment method, and you have done it lots of times, isn't it? Fixed installment method. Under the fixed installment method, which is also known as straight line method, it is also known as original cost method. As you know, depreciation remains same, annual depreciation remains same, correct? Besides, we have under it reducing balance method, also known as written down value method. Reducing balance method. And under it, as you know, depreciation generally in the initial years is high, and along with the time it gradually keeps on falling down, correct? Written down value method, it is also known as diminishing value method. And besides this, there is yet another that is known as sum of years of digit method. Sum of years of digit method. Sum of years of digit method. Besides, we have what we call double declining method. Double declining method. Double declining method. Several methods. 3 we have seen, 4 now we have just seen. Besides that, there is third broad classification, that is known as use-based method. That means use-based method. The more you will use, the higher will be the depreciation. One is known as working hours. Working hours. You must have heard about it in your costing, where you used to compute machine hour rate. Then there is what we call mileage method. Generally it is used in case of transportation. Mileage method. Mileage means distance here. Then third one is depletion method. Depletion, D-E-P-L-E-T-I-O-N. Depletion service hours method. Depletion service hours method. Then there is also one unit method. Unit method. Unit method. Correct? Besides, another broad classification is there, that is known as price based. Under it, price based. Under it we find actually one that is commonly used at revaluation method. Revaluation method. Then we have repairs provision method. So you have seen there are so many methods. So many methods, isn't it or not? Yes, sir. The chapter must be very long. I have already told you it's a very small chapter, to be very honest with you. I am simply telling you the different types of method. But how many methods in your course are there? That is important point. So, good thing is that as per AS10, see here, depreciation method as per AS10. This chapter is governed by AS10, correct? So depreciation method, whatever has been prescribed in your AS10, we have to follow those. Depreciation method as per AS10, accounting standard AS10. I have already told you depreciation is now governed by AS10. AS10 deals with property, plant and equipment, that I did tell you in the first session, isn't it or not? Depreciation method as per AS10, we find there are only 3 methods which have been prescribed. One is known as straight line method, as I just told, fixed installment method. It is also known as straight line method, and you have heard about it 1 lakh times. Straight line method. Besides, we have diminishing balance method. Diminishing balance method. Diminishing balance method, also known as written down value method or reducing balance method. Then there is one more method which has been actually prescribed, that is known as sum of units method. First 2 is already known to you. Third one, which is in your course, that's a new one. Of course it's not new. Sum of the units, not tough in fact. Sum of the units method. So these are the 3 methods which have been actually prescribed by AS10. Remember one thing, we have covered AS10 separately under separate lectures, correct? But in spite of that, if we find that any provision of AS10 is influencing this particular chapter 2, we will take that into account. Is it clear to you or not? Before we move further, now let's come straight to the point. We start with straight line method, correct? First, just to remind and recap the things which you have done. Remember one thing, I don't think you will be asked any long questions, correct, of entries or preparation of ledgers. No, I don't think so. You will be asked simpler questions, but where you will have to do some computations. So that's my view. 6 questions are there in your what we call module. We have given you 22. Reason is that we have covered the questions of standard also. Correct? So now we start with your straight line method first. Straight line method. 1. Straight line method. Under the straight line method, just wait. First we pick up a straight line method, correct? Okay, in order to comprehend this, but before we move further, let me actually remind you, straight line method is also known as you know, original cost method. Original cost method. Besides, it is also known as fixed installment method. Fixed installment method. Fixed installment method. Let's understand it first. Of course, it's very simple, no doubt about that. There is hardly any complications. Let us say this is 1/4/2018, correct? X Limited is a company, or let us say F1 Limited is a company. On 1/4/2018, this company, let us say, purchased a machinery, correct? And machinery is purchased for rupees, let us say 90,000. Machinery is purchased for rupees 90,000. We further presume that this particular company, after having purchased the machinery, spent what we call in bringing the machinery to its site, let us say expenses on cartage, transportation, handling, charges, etc. That means such expenses which are related to bring the machinery and install the machinery, correct? So 10,000 further expenses have been incurred. We further presume that life of this machinery is 5 years. For simplicity's sake, we presume the life of the machinery is 5 years. Is it clear to you? We also presume that after the end of the useful life, this is the fifth year. After the end of the useful life, let us say there is some residual value, also known as scrap value. We further presume, for simplicity's sake, that scrap value is 20,000, although I have taken it a little bit higher. No problem. We have to understand the concept. Moreover, you know everything. Now suppose if I ask you, my first question A, factors, which are the factors upon which you will compute the depreciation? I did tell you the factors which we consider in computing the depreciation. One is cost. Now what is cost? Cost is purchase price plus expenses. Isn't it or not? Cost is purchase price plus expenses, isn't it or not? Yes, sir. So in this case, purchase price plus expenses. Purchase price happens to be what we call 90,000. Expenses 10,000. So 90 plus 10 will make how much? That is equal to 1 lakh. So your cost without an iota of doubt is 1 lakh. That means this 1 lakh which you have spent, of course there will be outflow of 1 lakh, but at the same time it will bring returns to you till at least 5th year. And even after the 5th year, you will get back 20,000. Because you will get back something, even after the end of the useful life, that means there is some value associated. So in this case, residual value is positive. Residual value or scrap value, whatever you may like to write. Now residual value in this case, I have given to you 20,000. Because you spent 20,000, because you spent 1 lakh, but you got back 20,000. Could you tell me what is the exact cost for you on this machinery? So to be very honest with you, our cost should be 80,000. Absolutely. So that means In real sense, your cost is cost, I'm writing in bracket. In real sense, your cost is actually 80,000, correct? That is 1 lakh minus 20,000. And now we divide it by the life. The life of the machinery is actually 5 years. So we have taken the life to be equal to 5 years. So what should be the allocation of the cost? That means net cost during this 5 years is 80,000. You are going to use the machinery. So what is the allocation of cost if I am going to ask you? Allocation of cost is nothing but depreciation. So depreciation or allocation of cost. So what should be the depreciation or allocation of cost? That will be equal to 80,000 divided by 5, that is 16,000. Are you getting my point or not? So each year you are going to write off 16,000 because we are following a straight line method. Under a straight line method, each year we are going to depreciate this machinery by 16,000. Before we move further, let me also tell you, suppose if I ask you to compute the percentage of depreciation, don't commit here a mistake. I have seen a student committing mistakes. In order to compute the percentage, write the depreciation amount. Depreciation amount is 16,000 per year, of course. And write below real cost. So real cost is 90 plus 10, 1 lakh. It is not net cost. In order to compute the depreciation percentage, we shall base our depreciation upon the gross cost. For simplicity's sake, you can say so. So gross cost is 1 lakh and not 80,000. Remember one thing. So that is equal to into 100 because we are computing the percentage. So 16% is your depreciation rate. So we can say we are writing off this machinery at the rate of 16%. Say, see here. How will I write the depreciation? Correct? Because each one of you know. Now, when we write off the depreciation, see here. Where is the machine? Where is the scale? The scale is here. Here I am going to prepare this depreciation account, let us say for 3 years. Or if you want me, I can prepare it for 5 years. Correct? This is depreciation account. Depreciation account. Correct? Now, just pay attention. Take care of entries. Could you tell me what would be your entry on 1/4/2018? Because this is the date on which you purchased what we call a machinery. So your entry will be machinery account debit. Even the expenses will be debited to machinery because expenses have been incurred in connection with the machinery. So 1 lakh will be your total cost. 1 lakh account debit to bank account. This entry is not affecting the depreciation account, so we are not going to post this entry in the depreciation account. Of course, if you would have been preparing machinery account, then over there you would have what we call return to bank. If you want me, I can also prepare what we call machinery account. Correct? Let us say here we are preparing machinery account. Asset account. Correct? This is machinery account. So, because you purchased on 1/4/2018, this entry will affect machinery account. We will write here to bank and we will write here rupees 1 lakh. This is how we are going to proceed. Correct? Now at the end of the year when we will reach, of course, I need not require to tell you what should be my entry. At the end of the year, 31st/3/2019, that is the first year ending, I will pass an entry, depreciation account debit to machinery account. Because of this entry, what is happening? Because of this entry, machinery, the asset value will fall. Depreciation is at the rate of 16%. So 16% of 1 lakh for 12 months is 16,000. This is my entry. And if I am going to post this entry is affecting machinery and depreciation account both. So in the machinery account, I am going to write at the end of the accounting year 31st/3/2019, that is by depreciation. Correct? That is equal to 16,000. So my machinery account is getting reduced. Now after the end of the first year, the balance carried down in the machinery account, as you can see, okay, I will pick up this pen itself. Balance carried down, as you can see, is 84,000. Correct? So this is first year is over, and in the second year you will write here, first of all write the opening date of the second year. Opening date will be 1/4/19. You will write here to balance brought down. Balance brought down will be equal to 84,000. Isn't it or not? Correct? And because we are preparing depreciation account, in the depreciation account, if you want to prepare, in fact, that is, there is no necessity, 31st/3/2019, we will write here to machinery. The first year depreciation is actually 16,000. Actually, to prepare depreciation account, it's very easy. Say 16,000. Ultimately, one more entry will be needed to transfer depreciation to P&L, as I just told you, in fact, in the last session. Profit or loss account debit to depreciation I shall write, and the amount will be equal to 16,000. Is it clear to you or not? This is how the entries shall unfold. At the end of the year, 2 entries you need to pass. This entry will be passed only when you will purchase the asset. Is it clear to you or not? So, because of this entry, in the depreciation account, we will write 31st/3/2019. In depreciation account, only 2 things are needed: amount of depreciation and P&L. This account will automatically get closed. Because you incurred a loss of 16,000 in the current year, entire loss has been debited to profit and loss account. Is it clear to you? Now we move over to the second year. In the second year, once again, I will pass entries 31st/3/2020. 31st/3/2020, entry will remain same. 1 depreciation account debit to machinery account. Isn't it or not? Depreciation account debit to machinery account. Depreciation will also remain same, because depreciation will be charged on original cost. Now, original cost is considered as what? That is gross cost. 1 lakh into 16%, 16,000. So your amount of depreciation shall remain same. That is why. And again you are going to debit it to P&L. P&L account debit to depreciation account. That will be equal to 16,000. Is it clear to you or not? 16,000. So these are the entries which you need to pass each year. Only 2 entries. Are you getting my point or not? And moreover, each one of you know very well. So on 30, this is machinery account. At the end of the year, second year, 31st/3/2020, I shall write here by depreciation once again. Depreciation is based on a straight line method. So it will remain same, 16,000, 1 lakh into 16%. Now, you are going to again calculate the balance. See here, you are going to calculate the balance. Where is my calculator? What will be the balance? Nowadays, I do not want to take risk with respect to calculation. 68,000. Then I will bring this amount here, 1/4/2020. Third year beginning. 2 balance brought down. So machinery account is reflecting a balance of 68,000. Then again, now I am not going to write the entries. 31st/3/2021, Once again you are going to pass the entry, and according to that entry depreciation will come here to the extent of 16,000. Is it clear to you? Once again you will compute the balance. The balance will be like this: 68 minus 16, that is 52,000. 52,000. Is it clear to you? This balance is now over. We come over to the beginning of the fourth year, 1/4/2021. Once again I write here 2 balance brought down. 2 balance brought down happens to be 52,000. I write here 52. Moving over to the end of the fourth year, I shall write over here by depreciation once again 60,000. So 16,000 is your depreciation. 52 minus 16, it comes to how much? It comes to 36. So after the end of the fourth year, machinery account is reflecting a balance of 36,000. Please pay attention. 52,000 minus 16, 36. We come over to the beginning of the fifth year, that happens to be the final year. 2 balance brought down. Balance brought down is 36,000. Correct? Balance brought down is 36,000. Now, 31st 3/23 by depreciation 16,000. Is it clear to you? Just let me check all calculations are correct, right? So now balance carried down, 36 minus 16, that happens to be 20,000. Remember one thing, logically in original cost method there should not be any balance, logically, correct? However, if there will be some residual value, then there will be some balance. Is it clear to you or not? You can see in the question residual value I had given 20,000. So even after the end of the fifth year, machinery account is not yet closed because it is this balance is equal to residual value, correct? Actually there is a balance in machinery 20,000, we will call it this way, after the end of the fifth year. Now the life of this particular asset from the perspective of the business is over. So whatever value this particular fixed asset contains, now that will be termed as residual value of the asset. Is it clear to you? If we are going to sell it, this particular asset today, definitely we are going to command some value. We may command 20,000, we may command higher than that, we may command lower than that. Is it clear to you or not? Fine. Now we will finish up depreciation account also. See, actually you know the 2 entries are passed each year, correct? Now even in the second year, when I will pass the entry, again I will have to write here 31st 3/2020. At the end of the year, depreciation, each year 16,000, 16,000. So that means 5 times you will have to write over here. So as far as preparation of ledger account is concerned, it is fixed asset account which is important, because depreciation account only 2 things will come over here, and each year it will get closed also. So you can do it 5 times to wrap it up. Similarly, 31st 3/2021, you will write here 2 machinery, correct? You will write here 2 machinery, and the amount of machinery depreciation is 16,000. 31st 3/2021, we will write this off to P&L, that is 16,000. So 5 times you will have to do this to complete the proceedings. 31st 3/22, 2 machinery account, formalities are there, so we have to somehow carry those out. 16,000, 31st 3/21, that is profit and loss account 16,000. Then 31st 3/23, 2 machinery, 16,000, and 31st 3/23, we will write here by P&L, and we will write here 16,000, and this will be over. Point is not that I want to show you how ledger accounts are prepared. Each one of you know. Number one. Number two, I just want to tell you the entries. Now, as far as entries are concerned, see here, entries. Now I am writing format of entries. Whichever method we may follow, remember one thing, whichever method we may follow, either we are following a straight line or say we are following written down value, and later on we will see what we call sum of units method. So whatever method we are following, we have two options of writing the entry. One option is known as when depreciation is charged, when depreciation is charged directly to asset. In fact, this is the procedure we followed in this question. Remember one thing what I am telling. Whatever method you may follow, whether you are following written down value, sum of units method, or straight line method, we have two alternatives to solve the question. Of course, in examination, we need not require to solve the question from both the alternatives. You will be given which method you have to adopt. But at least you should know. When depreciation is charged directly to the asset, our entry, you know, what will be our entry when we will charge? Of course, the first entry will always be for purchase of fixed asset, is although not needed, but still I am writing. Tangible fixed asset, TFA, tangible fixed asset account debit to bank account. This is the entry for purchase of fixed asset. This entry will be passed on the date on which asset was acquired during the financial year. It might be acquired in the beginning of the year or in between the year, correct? Now, these entries you will pass at the end of the accounting year. Because we have decided that depreciation is we are going to charge to asset, so it means when we are going to charge the depreciation to the asset, depreciation is a loss. Obviously, we are going to debit depreciation account, and because we are charging it to the asset account, the tangible fixed asset definitely will fall. Correct? The value of tangible fixed asset will decrease. So depreciation is a loss, we are debiting, tangible fixed asset value is falling, so we are going to give it a credit. And at the end of the accounting year, correct, I will write in bracket depreciation charged. Depreciation charged. At the end of the accounting year, as you know, we are going to pass the entry profit or loss account debit to depreciation account. It means depreciation transfer to P&L account because it's a loss. So these are the entries normally we pass. Depreciation charged or transferred to P&L. Normally these are the entries which we pass, correct, when we charge depreciation directly to the asset, correct? Presuming, because now the following entries depends upon the fact what question states. Suppose question states that later on this particular machinery is also sold out. Now if machinery is sold out, correct, for sale of machinery, for sale of machinery, you will pass a simple entry. Bank account debit, correct? Bank account debit. Because you are selling the machinery, there may be a loss. If there is a loss, you will debit P&L. Because you are selling your machinery or tangible fixed asset, you will credit the asset account because asset will move out. There could also be a possibility instead of loss you may have profit. So you will write here 2 P&L. That is profit. Either of these two will come in this entry. Are you getting my point or not? When we will sell the assets, simple entry. So this will be the entry we will pass only if the question states that machinery is sold out. This is the method generally referred to. This is the method most of the time we as an accountant actually adopt. Is it clear to you or not? However, question may sometime ask you to solve the question when depreciation is not directly charged to the asset. When part B, where is the red pen? Second set of entries. These entries will be adopted if the question states that when provision for depreciation account when provision for depreciation account is maintained. Often the entities decide that instead of charging the depreciation directly to the fixed asset, what we will do, we will create a provision for depreciation account. Now, what is the difference between these two? I will let you know in a short while, but first you write the format of the entries. Suppose if I am following this what we call way of accounting, then in that case, purchase of fixed asset, same entry as we wrote earlier. Purchase of fixed asset. If you are purchasing, when I am writing fixed asset, it means tangible fixed asset, correct? So my entry will be tangible fixed asset account debit to bank account. To bank account, correct? This is the entry for purchase of fixed asset. When you decide that you are not going to charge depreciation directly to the fixed asset, rather you are going to create a provision for depreciation account, in that case what we would do? We will still debit at the end of the accounting year, we will still debit depreciation account. I will write the narration, depreciation provision. As I wrote, purchase of fixed asset, this entry is for depreciation provision. Let me first of all write the narration. I am writing narration at the top. So think of the entry which you wrote earlier in the first method. When depreciation is charged directly to the fixed asset, your second entry at the end of the year which you used to pass, depreciation account debit to fixed asset. Now here you are not charging depreciation to the fixed asset directly. So what you are going to do, depreciation account debit. Depreciation account debit. You will compute the depreciation in a normal manner, correct? And instead of writing two fixed asset, we will write two provision for depreciation account. Provision for depreciation account is often referred to as accumulated depreciation account also. So provision for depreciation account or accumulated depreciation account, whatever you may like to write. Provision for depreciation account. Now provision for depreciation, it's pretty long word, so I will simply write PFD. Whenever I will write PFD, understand that it stands for provision for depreciation. So that is the difference between the first and the second methodology, correct? Now at the end of the year, at the end of the year, what I am going to do now? Just wait. Well, in this methodology, as I said, instead of crediting what we call fixed asset account, we are going to create a provision for depreciation. Correct? Now, next entry will be, in the first year, in the beginning, you have passed the entry. These two entries will be passed at the end of the year. At the end of the year. At the end of the year, now, see here, this depreciation which you have written over here, it will be transferred to P&L. Transfer of depreciation. Transfer of depreciation to P&L. Transfer of depreciation to P&L. Now what is the entry for the same? It is almost same entry. Profit and loss account debit to depreciation. Correct? Profit and loss account debit to depreciation account. Same entry. Only difference lies here. Correct? Now, the big difference is that between this methodology and the one which we adopted, in the first method, because we are charging depreciation directly to the fixed asset, in the first method, the depreciation will, the fixed asset will appear in the balance sheet at reduced value. At reduced value. Correct? The asset will appear at reduced value. Just to cite the point, don't write it, just I am signifying. See, in the previous case, correct? In the previous case, cost of machinery is 1 lakh, gross cost. For the purpose of depreciation computation, we subtract residual value. For the purpose of calculation, we computed depreciation this way, divided by 8 life. So 16,000 depreciation. Now whenever we will prepare ledger account, we will need only the gross cost. Correct? So in the first method, at the end of the first year, in the balance sheet, when you will reflect the fixed asset, it will be like this: 1 lakh minus 16,000. And we had prepared machinery account also. From there on also you can see that at the end of the first year, balance in the machinery is 84,000. That means the first method, when depreciation is directly charged to the asset account, the asset appears in the balance sheet at net value. Correct? However, in this method we will see later on, correct, because we are not charging the depreciation. Suppose same data, now I am adopting this approach. Under this approach, fixed asset at the end of the first year will appear at 1 lakh only. You can see, because we are not charging the depreciation straight away to the fixed asset account. Correct? So fixed asset under this method of will or shall always appears in the financial statement at cost. But our financial statement should reflect the correct picture. The correct picture is that value of your fixed asset is 84. But under this approach, fixed asset will appear at 1 lakh. But simultaneously, towards the liability side, we will also write provision for depreciation. You can see provision for depreciation account is not closed. Rest of the accounts have been closed, but this account is not closed. So it is reflecting a credit balance, and the credit balance must be equal to 16,000. So you can see in this method, we can derive the net value by subtracting 16 from 1 lakh. So ultimately the results will be same. Only thing is that in this method, correct, when provision is made or when the concern decides to transfer what we call depreciation to a provision, separate provision for depreciation account. So in this method, provision for depreciation appears here and towards the liability side, and of course fixed asset will keep on appearing what we call till its useful life is over. Till that time it will appear at cost, original cost. Is it clear to you? So that is the basic difference between these two methods. We will come over to that again deeply. So this sheet was only meant for reference, so just pay attention. So under the provisioning, when concern decides that we are going to charge or not charge depreciation to the fixed asset, rather we are going to provide for depreciation, correct? So in that case, these entries are passed, and we will keep on pass till the life is over or till the asset is sold. Now suppose asset is sold in this method. In the previous method, when asset was sold, simple entry was cash account debit to asset account. Depending upon loss or profit, we will debit P&L or credit P&L along with that. Simple entry. In this case, what happens? Important. Sale. Where is the red pen? Entry number D, I am writing sale. Depending upon the question. Sale of asset. Sale of asset. Suppose there is sale of asset, correct? First thing what you should do, although it is not necessary, but my advice to you is, whenever you follow this method and asset is sold, in that case, the first thing what you should do, you close your asset account by transferring it to what we call a newly opened account known as assets disposal account. Although it is not necessary, I am talking. Correct? There are many approaches, in fact, but the best approach I am bringing to your notice. That's the important point. So, if there will be sale of asset, first thing what you should do, transfer of asset account to asset disposal account. To asset disposal account. That means after the end of the accounting period or on that date on which the asset is sold, whatever balance is there in the asset account, logically it will be at cost only. So that balance will be transferred to asset disposal account. Because now you are closing your asset, and asset always has a debit balance, you are closing it, you will now write the entry asset disposal account debit, because this new account is coming into play. Asset disposal account debit, and you are closing your asset account, so you will write here to asset account. So as far as your asset account is concerned, its story is over, or in more simpler words, now you substitute asset simply with asset disposal account, correct? Now this asset is sold. When you will sell this asset, see, when sale of asset, whenever you will sell the asset under this method, first close the balance of your asset by transferring it to asset disposal account, correct? Now you write entry for sale, that is receipt of cash for sale. When you are going to sell your asset, you are going to receive cash, bank account debit. As I just told, there could be a loss or profit. If there is loss, you will debit P&L. Now you don't write to asset account, because your asset account is closed. Instead, word asset is now substituted by asset disposal. So you will write here to asset disposal account. Asset disposal account. Asset disposal account, and whatever profit is there, to P&L. I intentionally wrote this entry just to make it little bit more compatible with the entries which we did in the first method. Even in the first method, we sold the asset, because in the first method we were not transferring the balance, although this method, this part can also be used in the first method. But generally, accountants do not use this methodology in the first case. So, however, in this particular case, this particular methodology is widely used. So that is why you should be aware of this particular methodology. when you are not charging depreciation to the fixed account, rather what we call creating a provision for depreciation. In that case, if you happen to sell the asset, logically your first entry is to close this particular account, is to close this account, correct? But before passing this entry, sale entry, problem is that your asset account is reflection of cost. I just told you, in this method, asset appears at original cost only. Now the problem is that we cannot compute loss or profit. We cannot compute loss or profit without knowing the book value of the asset. So before sale, because we have written here loss or profit also. So before sale, logically what you should do in order to know the book profit? In order to know the profit, first of all, what you should do before the sale, logically you have to pass, this should be your second entry and this should be your third entry, correct? This was made intentionally to make you understand in a better way, but now we have to understand the logics also. We cannot compute what we call loss or profit without passing this entry which I am going to pass, because asset disposal account is at cost. We cannot determine what we call loss or profit without having book value in front of us. Book value can be determined only when from the cost you will when you are going to actually, just wait, okay, talking to the staff also. So now in order to estimate the book value, you have to actually subtract the total accumulated depreciation, that is total provision for depreciation, from that asset. Now problem is that asset disposal account is there instead of asset, because asset account has been closed. So next entry after this entry, what you should write, you will take into account total provision for depreciation. Total provision means, or simply provision for depreciation means, total depreciation till the date of sale, and that would be reflected by provision for depreciation account. So you will have to close both asset account and the provision for depreciation account, correct, to know the book value. So provision for depreciation account, whatever provision was there with respect to this asset, now you are going to transfer it to asset disposal account. Asset disposal account. Asset disposal account. Then only you will have in front of you the book value, and then you will compare the book value and the sale amount to know your profit or loss. Then only you will be able to pass this entry. Entry number 1, entry number 2, and entry number 3. This entry, why this entry? Because we want to bring the asset to its book value. You will be able to comprehend this only once we are going to do the what we call practicals, and I have definitely, we are not going to shy of that. We are going to actually do the practical in front of you with respect to this one. In this part, just purpose was to familiarize with you with the what we call type of questions. We shall have 3 types of questions based either on what we call, as I said, straight line method, or then written down value method, or finally sum of units method. We are not going to have questions wherein we will have to actually prepare the ledger accounts and pass the entries. No, don't forget about such questions. You are going to in fact have computational based questions of 3 or 4 marks. Total 6 questions are there in the module, correct? A very simple 6 questions are there. We are going to cover all those. Don't worry about that. In fact, after having covered till up to this particular point, you should be in a position to do the first 4 questions of your own, to be very honest. Anyway, in the last one, we have had a look over some concepts, and we are going to actually now discuss those concepts with the help of some case study, correct? So here we take example. Another example to supplement the points which we made in the last session. This pen is not working. Anyway, we presume this is the beginning, this is the date 1/4/2018. On this date, let us say machinery is purchased, correct? Machinery purchased. And machinery is purchased let us say for rupees for rupees 1,90,000. 1,90,000. We purchased a machinery, let us say for 1,90,000. We also incurred some expenses in carriage, cartage, transportation, handling, etc. Correct? Expenses incurred. Let us say these expenses are worth rupees 10,000. We presume that this machinery has got a life of 1 year, 2, 3, 4, okay, 5th year. Correct? This machinery has a life of 5th year, after which this machinery has got a life of 5 years, in fact, after which its residual value, let us say its residual value is estimated at rupees 10,000 for simplicity's sake. I'll make it 20,000. 20,000, correct? So, this machinery is having a life of 5 years. Let us say company follows a straight line method. Companies follows a straight line method, because we are still discussing a straight line method, correct? Now, suppose if I would ask you to let me know what is the amount of depreciation per annum, you should be straightway let me know that depreciation is computed by taking into account following factors. One, cost. What is the cost? 190 plus 10. This is your cost. Purchase price plus expenses. This is your cost. From this cost, you are going to subtract residual value, which is 20,000. 2 lakh minus 20,000. And we have estimated the life as 5. These three elements will be taken into account to compute the what we call depreciation. So 180 divided by 5 gives me 36,000. So 36,000 per annum is your depreciation. It is better to compute the percentage also. Percentage. While computing the percentage, only cost is taken into account. Your cost is 2 lakh and depreciation per annum is 36,000. So 36,000 divided by 2 lakh into 100. That gives you, I think, 18%. 36 divided by 200 into 100. Right, it is 18%. So 18% per annum is your depreciation. Correct? Now, just pay attention. I will stress the question further also. Suppose company decides to charge depreciation to asset account. So company has decided to charge the depreciation to the asset account. In this case, how my accounting will unfold? Just have a look over here. Obviously, the main ledger account is the asset account. So asset account is machinery account. We shall prepare the machinery account. Here I am preparing it. Correct? This is your machinery. You have decided that depreciation will be charged to the machinery account. Well, starting date is 1/4/2018. On 1/4/2018, your entry will be machinery account debit to bank account. Isn't it or not? So you will write here to bank. Just let me settle these sheets first. The sheets actually creates problem. On 1/4/2018, you will write here to bank. You must write here the cost. Cost is rupees 2 lakh, 190 plus 10, isn't it? you will reach the end of the accounting year and you will write the entry depreciation account debit to machinery. Depreciation. You have your depreciation is 18%. If you will compute 18% of 2 lakh, it will be equal to 36,000. That means balance carried down after the first year is 1,64,000. Of course, this depreciation will be transferred to P&L. That's a different matter. Now, we come over to the second year, 1/4/2019. We write balance brought forward. 164 is the balance in the machinery. 1,64,000. We reach the end of the accounting year. At the end of the accounting year, same entry will be repeated, depreciation to machinery account. However, depreciation will be computed on 2 lakh, original cost method, fixed installment method, or what we call a straight line method. So 36,000 will be your depreciation amount. Once again, you will compute the balance. I do not want to take the risk. So 164 minus 36, that gives me 128. That means at the end of the second year, your machinery account in the financial statement will be reported at 1,28,000. Correct? Then we come over to the third year also. Just pay attention over here. In the third year, that is 1/4/2021. 20. First of all, we need to write balance brought forward. Now, balance brought forward, let us say, is 1,28,000. We reach the end of the accounting year, 31/3/21. Depreciation. Correct? Depreciation, of course, will remain 36,000. And once again, I shall compute balance 128 minus 36, that gives me 92. How much? 92,000. Now, life of the machinery is no doubt about that 5 years. Machinery of life is 5 years without an iota of doubt. However, it is not necessary that if the life of the machinery is 5 years, we are going to use it for 5 years. Due to some or other reason, sometime concern sell the relevant asset. Correct? Let us say company might be feeling that this particular machinery, even though having a life of 5 years, is giving us some headaches, some problems, or because this machinery has gone out of fashion, or some new improved machinery has come up in the market. So due to some or other reason, we decided to sell this machinery. For simplicity's sake, let us say machinery is sold on. That means I am now revising the question. I will write it also. Suppose machinery is sold. I am stretching the question further. Suppose said machinery, said means this machinery is sold on 31st of December 21 for rupees 40,000. Now, because we sold the machinery, first of all, you need to know the date on which you sold the machinery. Now, your fourth year, the current accounting year, is starting on 1/4/2021, and it will end on 31st of 3. Just let me make it clear here diagrammatically. This is your fourth year. Correct? The fourth year, as you can see, is starting here, 1/4/2021. Of course, it will end on 31st of 3, that is 22. But what you did, you sold the machinery. You sold the machinery on 31st 12/21. Because you sold the machinery on this date, so first of all, what you are going to do? you are going to compute the depreciation only from this particular date till this date. That means for this period you are going to compute the depreciation in this year. Of course, it is 9 months. So in this period, first of all, you need to compute the depreciation. Now I will compute the depreciation and I will write it over here, and I will have to keep the track of the date, 31st of 12/21. I will write the date depreciation. I will compute the depreciation. Remember, you are following a straight line method. Under straight line method, depreciation is computed on original cost, 2 lakh, into rate of depreciation is 18%, and we are computing depreciation for only 9 months. Isn't it or not? So that is equal to 27,000. So depreciation on this date is 27,000. You are getting my point or not? That means, just pay attention here, it is very important. Book value on this date of this machinery, or value of this machinery in the beginning of this particular year in which you sold the asset, is 92,000. And you sold the asset on this date, and the depreciation in the current year is 27,000. So we may say on the date of sale the book value is 92 minus 27. 92 minus 27, that is 65,000. So book value on this date, on the date of sale, is 65,000. On the date of sale, you need to know the book value. So, and book value can be easily arrived, there is no problem. Now you will have to compare it with the sale price. You sold this machinery on this date, sorry, I have to put up the arrow like this. Selling price is only 40,000. So 65,000 worth of asset is going out for 40,000. So there is a loss of 25,000. Just a moment ago, I told you, even in the last session actually, I did tell you the entry for sale when we are following the method charging or depreciation directly to asset. So in this case, entry on the date of sale, of course it is not needed, but just to make the point clear, my entry will be like this: bank account debit, I am receiving 65,000, sorry 40,000, because I am selling it for 40,000. There is a loss, I will debit the loss, that is 25,000. And machinery worth rupees 65,000 is moving out of the business. That means when depreciation is charged directly to the asset and machinery is sold, in that case there is no major problem as far as entry for sale is concerned. This will be your entry for sale. Is it clear to you? Now, if you are going to post this entry, you are going to write on the same date, on 31st of 12/21 you sold out the asset. You can see in the entry, machinery account is getting credited by bank, due to bank 40,000, this is sale amount. There is a loss also worth rupees 25,000. So these two figures will come here. Because you are having only one machinery and that machinery has been sold out on this date, so there should not be any balance in the machinery account. So obviously when you will tally it, it will tally of its own. This is the method in which we are charging the depreciation directly to the asset account. Correct? Now, same question I will solve with the help of second methodology. Correct? Same question, now I am solving. Suppose depreciation provision is made. Indirectly, it means company is not charging the depreciation to the asset in this case. Instead, company decided to actually create a provision for depreciation account, also known as accumulated depreciation account. Same data. Once again, I will prepare the what we call machinery account. I shall need that. We also presume that machinery was sold as it was in the last question, correct? So, with these presumptions, we prepare machinery account under this situation. Suppose company decides that we are not going to charge depreciation straight away to the machinery account. So in this case, it becomes imperative, it becomes necessary, it becomes utmost what we call urgent for you to, besides preparing machinery account, also prepare provision for depreciation account. I'll prepare it here itself. So we are going to prepare a provision for depreciation account also. Provision for depreciation account. It is important. What will be your first entry under this method? Entry will be same. On 1/4/2018, you will write here 2 back. You purchase the machinery for 190 plus 10, that is 2 lakh. Isn't it? It was 2 lakh. Of course, on 31/3/2019, I will pass another entry. What will be my entry? First entry is fixed asset account debit to bank account. When I will reach the end of the second year, my entry will be depreciation account debit to machinery? No. My entry will be depreciation account debit to provision for depreciation. So that is why depreciation will not come here, because provision for depreciation is credited due to depreciation. So we are going to actually write here 31/3/2019 by depreciation. And depreciation, because we are following a straight line method, that is 18% of 2 lakh, that is equal to 36,000. This is the amount of depreciation, correct? Of course, whatever depreciation we provided, we will put it on the debit side of P&L also. Now, first year is over. So you can see in the first year, machinery in the financial statement will be reflected at cost, 2 lakh. In this method, because you are not charging the depreciation straight away to the machinery, so machinery which you are going to reflect later on towards your asset side, so it will be at cost. However, besides machinery, you will reflect in the balance sheet this particular figure also. On 31/3/2019, there will be a balance in this account, provision for depreciation account. You will write here to balance carried down, and this 36,000 will be reflected towards the liability side. This is balancing figure. Is it clear to you? So now, again, we reach the second year. In the second year, what will be my entry? Will I purchase machinery again? No. So machinery will not get affected. In fact, this balance carried down, see here, logically, I will write here 1/4/2019 to balance brought down. Beginning of the second year. At the end of the second year, I will not write anything in this account. My entry will be depreciation account debit to depreciation provision. So in the depreciation provision account, I shall write towards the credit side once again by depreciation. 36,000. You are getting my point? Now we will balance this account. So you can see even at the end of second year, machinery is getting reflected at original cost of 2 lakh. So whenever provision for depreciation is made, machinery account comes in the financial statement at gross amount, at original cost amount. Is it clear to you, or simply at cost? And besides that, actually I haven't written here balance brought down. 1/4/2019, in fact, balance brought down in provision for depreciation is 36. We haven't written it. And now we will reach the end, 31/3/2020. This is second year end. So by the end of second year end, you can see total balance 31st/3/2020. Total balance in provision for depreciation account is 72. So at the end of second year, my balance sheet is reflecting machinery at cost 2 lakh and liability side provision for depreciation 72. So I can find the book value. That's a different matter. 2 lakh less 72, that is the book value after the end of the second year. But machinery will come at cost separately and provision for depreciation will come separately at 72. This 72 figure shows the total accumulated depreciation for 2 years. Correct? Now, we enter the third year. 1/4/2020. Machinery account, balance brought down. 2 lakh. We know machinery will remain unaffected, because at the end of 31st/3/2021, we are not going to provide any depreciation in this account. So 2 lakh will be again balancing figure. So by the end of the third year also, machinery account will reflect a balance carried down of 2 lakh. Correct? This balance carried down will be opened up in the fourth year. 1/4/21, we shall write here 2 balance brought down and the amount will be equal to 2 lakh. Now I am going to, this is the third year, sorry. So first of all, third year is starting here, 1/4/21. Let me write the balance brought down. Balance brought down is 72,000. At the end of the third year, I will again write depreciation. Depreciation is 36. And I will close this account. When I will close this account will reflect a closing balance. This is basically credit balance of 1,08,000. This 1,08,000 is nothing but aggregate depreciation till up to third year. That means total in 3 years we have provided depreciation 1,08,000. Now fourth year will start 1/4/2021. I will write here balance brought down, that is 1,08,000. Now in the fourth year, as we know, as we did in the last question, correct, on 31st of 3, we sold the asset. If you remember, when provision is made, I wrote some entries. See here. Once again, I will repeat. 31st/3/21. This is the date of sale. On this date, you sold the asset. First thing which you should do, under this method, when depreciation provision is being maintained, on the date of sale, what you do, you simply first of all compute the depreciation. We have already computed the depreciation for the 9 months, which was in the last 27,000, isn't it? So I will write the entry. Depreciation account debit. To provision for depreciation account. Provision for depreciation account. 27,000 worth of depreciation we have provided in the current year, correct, is starting on 1/4/2021, and on 31st/12, in fact not 3, 31st/12/21 is the date of sale. So from 1/4/2021 till 31st of 12/21, 9 months depreciation is 27,000. This depreciation you compute it on original cost, that is 2 lakh, because we are following a straight line method, don't forget it. 18% into 9/12. When you will pass this entry in the depreciation account, provision for depreciation account, which we are maintaining here, correct, I will write here 31st/12/21 till the date of sale. In the current year, depreciation is 27,000, correct. Now because this machinery Okay, before I proceed further, let me make one point clear. We have computed the depreciation till the date of sale. This is the first thing which you should do whenever you are going to sell the asset under this method. Second thing, what you should do. Now, second thing which you should do is to transfer the total provision balance to the asset disposal account. Write here provision for depreciation account. Now you will have to compute the balance in the provision for depreciation account. See, provision for depreciation account, if I am going to compute the balance 1,08,000 plus 27, that is 1,35,000. This 1,35,000 balance, correct? This 1,35,000 balance will be transferred to asset disposal account. Provision for depreciation account debit to asset disposal account. You write asset disposal account. Total balance is 1,35,000. On the date of sale, total aggregate depreciation on this machinery which is being sold out, and because you are having only one machinery, so whatever depreciation balance is there, you close it by transferring it to asset disposal account. As per this entry, you are going to write on the date of sale 31st/12/21, correct? You will write here to asset disposal account, asset disposal account, and this account will get closed. Now provision for depreciation account is closed, 135. This balance now transferred to asset disposal account. It means we will have to prepare asset disposal account also. That is why I left this space. Asset disposal account. I will prepare asset disposal account. In the asset disposal account, because we have written in the provision for depreciation account on the debit side to asset disposal, so 31st/12/21, I will write here what? I am gonna write here by provision for depreciation account. Provision for depreciation account. That is 1,35,000. First thing you should do is to compute the sale for the current period. Transfer the balance of provision to asset disposal account. Not very tough, correct, if you will think logically. Now you close your asset account. Whatever balance in asset, of course the balance will be at cost only. Whatever balance is there, close it to asset disposal account. But write the entry correctly. Because a new account is coming into play, that is asset disposal account, so it will be debited. Asset disposal account. And your asset account is getting closed, and assets, as we have seen, generally have debit balances. So we are going to close it by crediting the asset account. So asset disposal account is coming into play. Your old asset is going out of the business, I mean to say moving out of the site, and that asset is actually machinery. So you are going to write asset disposal account debit to machinery account. Balance is 2 lakh. That means now both provision for depreciation and machinery account have been closed. See here, I will write here 31st/12/21, date of sale. I will write here by asset disposal account. I have transferred this balance to asset disposal account. You got my point or not? So as you can see, this account is now closed. We need not require to look at this particular sheet. Now you must understand, simply by cramming you will never ever understand the concept. So try to have a broader view. When we have written in the machinery account by asset disposal, so on the debit side of asset disposal on 31st/12/21, we are going to write here to asset account 2 lakh. Actually, asset disposal account is prepared. Why? To know technically The book value, you can see the difference, 2 lakh minus 135, the book value is 65. So this 65,000 has been sold for 45. Now you will write this entry. Bank account debit. Now you are selling the asset. Now you have the book value in front. Bank account debit. How much you sold it for? 40,000. There is a loss. 25,000. I should not write asset account because asset, the story of the asset is already over. Now in front of us is asset disposal. So to asset disposal account. So that is why I am stressing that whenever you are creating a provision for depreciation, it is better to pass the asset disposal entries. That helps in assessing the what we call loss or gains. Asset disposal account, 65,000. All you need to do is to transfer this by bank. You will write here towards the credit side of asset disposal, 40,000. You will write here by P&L. That is 25,000. I hope now you got a fair bit of idea regarding these two methodologies of accounting entries. Is it clear to you or not? You must understand the concept. So such questions you will face in the examinations. You are not going to face questions like prepare simply ledger accounts and entries as you used to face in your class 11th or BCom level. So that is not the case here. Is it clear to you or not? So in the last one we actually completed one illustration, in fact one example you can say so. And in that example we saw that depreciation is being charged directly to the what we call asset account, and asset was also being sold out. So now we are picking up a question that is question number 6 of the module, which these are revised module. Please pay attention. These are the revised notes which we have sent and attached under the resource column of the section depreciation. When you will click the section depreciation, you will have two things in front of you. One resources and another one is lectures. You click the lectures. You click the what we call, resource column. You will find these notes appended over there and you can download it. Question number 6 now I am picking up. Correct? In this question number 6, let me write with the red pen. Question number 6. What is this question number 6? I will explain it also and I will go through the question. Question number 6 states that there is a company by the name of F54. The name of the company is F54, correct? And accounting year is the calendar year of this company. Accounting year is the calendar year, correct? I will go through the question, don't worry. We will see later on that question is starting on 1/1/2018. When we will go through the question, we will find that this company purchased a machinery on this date, and I am writing M1. Machinery, this is the first machinery which is bought by this company for rupees 1 lakh on 1/1/2018. Since accounting year is the calendar year, this accounting year will end on 31st of 12/2018, correct? Then in the second year which would commence on 1/1/2019, of course, and end on 31st of 12/2019. In this accounting year, this particular company bought another machinery on 1/7/2019. On this date, this company bought another machinery, M2, and this machinery is costing rupees 1,50,000. This is stated in the question, correct? Further, the question states that in the next year now, which happens to be the third year, in the next year what is happening? No new machinery was purchased. However, question states that on 31st of 12/2020, when you will look into the question, you will find third line stating that, in fact, second line, it is stated that on 31st of 12/2020, machinery purchased on 1/1/2018 was sold for 50,000. On this date, Machinery which you bought on this date, that means M1, first machinery was sold out. M1 sold, and M1 was sold for rupees 50,000. Sold for rupees 50,000. 50,000. Question further states that company provides depreciation on SLM basis and rate of depreciation given to you is 15%. It is also written that company closes its books of accounts on 31st of December every year, and further it is also stated that you prepare machinery account, machinery disposal account and provision for depreciation account. So it means in this case depreciation is not being directly charged to the asset, rather company is creating what we call a provision. Correct? Although to be very honest with you, entries are not needed, just to remind you, correct, because question has simply asked us ledger account, and mostly you will be asked only ledger accounts. In spite of that, correct, in spite of that, let us say in the first year what will be your entry? 1/1/2018. Now we start the solution. This is our solution, correct? Now could you let me know what will be the entry on 1/1/2018? 1/1/2018, machinery is purchased. We will write machinery account debit. Machinery account debit. You write in bracket M1. This is the first machinery which you bought. To bank account. Correct? Machinery is bought for rupees 1 lakh. So you shall write here 1 lakh. Obviously, when you are going to reach the end of the year, 31st of 12, 2018, you will debit the depreciation, which is a loss to you. However, we are not going to credit machinery account. Correct? In this question, we have to make provision for depreciation, which automatically means depreciation is credited to provision for depreciation account. So we shall write, instead of machinery, we shall write to provision for depreciation account. Correct? As we know, rate is actually 15%, so 15% of 1 lakh is 15,000. Not very tough. Of course, this depreciation will be transferred to profit and loss account also at the end of the year. If you want to write the entry, you can write so. Profit and loss account debit to depreciation. This will be the entry. Depreciation. So 15,000 depreciation which you provided will be debited to P&L. First year is over. Now we come over to the second year. In the second year, what is happening? See here. I will keep this sheet here. Just let me actually put up some paper weight. Sheets are flying otherwise. Now we come over to the second year. The second year, we are purchasing yet another machinery, but in the second year, we are purchasing machinery on 1/7/2019. Another machinery was purchased, so we shall write machinery account debit. Machinery account debit, we will write in bracket M2. This is the second machinery which is bought on 1st July 2019. Machinery is bought for 1,50,000, so you shall write to bank 1,50,000. At the end of the year, you are going to provide depreciation. You will reach the end of the year 31st of 12/2019. You'll provide the depreciation. Your entry will be depreciation account debit. Depreciation account debit. 2. Provision for depreciation account. How will you provide the depreciation? Remember one thing, there is already a machine with you, correct? So when you provide the depreciation at the end of the second year, you will provide the depreciation on M1. Cost of M1 is 1 lakh. depreciation from the beginning of the second year till the end of the second year will be at the rate of 15%, 15,000. This is depreciation on M1. Are you getting my point or not? You will also provide depreciation on M2. But don't let it skip out of your memory that M2 is purchased in the current year, that is starting from 1/1/2019 ending on 31st of 12/2019. So you would compute the depreciation only from the period 1/7/2019 ending on 31st of 12/2019. So M2 purchased for 1,50,000. Depreciation 15%, of course, but you will provide depreciation for 6 months. Are you getting my point or not? Where is the calculator? Depreciation will be computed for 6 months only. 1,50,000 into 15% divided by 2, 11,250. So at the end of the second year, total depreciation on M1 and M2 provided is this much, 26,250. 26,250. Is it correct? 26,250. Of course, whatever depreciation you provided in the current year, you will transfer to P&L, profit and loss account, debit to depreciation account. You will transfer to P&L. 26,250. Correct? Now we come to the third year. In the third year, what is happening? 31st. We did not purchase as any machinery, so in the third year, directly we will come over to 31st 12/2020. At the end of the year, first of all, we need to provide the depreciation. We will provide the depreciation. Depreciation. Depreciation account debit to provision for depreciation account. Provision for depreciation. How much depreciation you will provide in the third year? You will provide depreciation on M1, that is 1 lakh, because we are providing depreciation on a straight line basis, original cost 15%. So for full year depreciation is 15,000. We will also provide depreciation on M2. Now M2 was purchased for 1,50,000, and depreciation for full year you are going to provide beginning from the third year till the end of the third year. Is it or not? So 1,50,000 into 15%, that comes to 22,500. So total depreciation provided is 37,500. 37,500. Correct? Just to make the point clear, you need not require this thing, but just to make the point clear, correct? If I will ask you how much depreciation we have provided on M1, total depreciation on M1, total depreciation on M1, the total depreciation which you provided on M1, in 2018 you provided 15,000. 2019 you provided 15,000, and in the third year you provided again 15,000. So total depreciation provided on M1 is 45,000. Correct? Actually there is no need. Suppose if I ask you how much depreciation you have provided on M2. No depreciation in 2018 because you bought this machinery in 2019. In 2019 you provided depreciation to the extent of 11,250 on machinery 2 and 22,500 worth of depreciation in 2020. Total depreciation provided is 36,000, in fact 33,750, I think so, 33,750. Logically, if I am going to add these two, suppose if I am going to add these two, that is 45,000 plus 33,750, that comes to 78,750. This 78,750 is nothing but the balance carried down in provision for depreciation account, because whatever depreciation we are providing, we are accumulating it in what we call provision for depreciation account. Now on 31st of 12/2020 we sold out which machinery? Machinery 1. The machinery which you have sold out, total accumulated depreciation of that machinery, total accumulated depreciation of that machinery which you have sold out, correct, will now be transferred to asset disposal account. This is very important. So first entry you have passed this one in the year 2020. Second entry on 31st of 12/2020, which you will pass total depreciation on M1, correct, because all this depreciation, even this one and this one, is being accumulated in provision for depreciation account. Now you will take away the depreciation with respect to M1, which is accumulated in the provision for depreciation account. Now you will have to transfer it to asset disposal account. So your next entry will be provision for depreciation account. Provision for depreciation account will decrease because now you are taking away total accumulated depreciation of M1. I'm simply writing in bracket accumulated depreciation on M1. So total accumulated depreciation on M1 is 45,000. This will be transferred to asset disposal account. Asset disposal account. Number 1. Number 2, in fact this is second entry, and number 3, what we are going to do, we have sold out M1, correct, we have sold out M1. We will transfer the balance of M1 to machinery disposal account. As we know, when depreciation is not charged directly to the asset gets reflected always at cost. That means in the machinery account there are two machinery. One is worth rupees 1 lakh, another one is worth rupees 1,50,000, of course at cost. So we have sold out M1. So that machinery which we have sold out now will be transferred to asset disposal account. So your next entry will be asset disposal account debit, asset disposal account debit. This is M1. Now cost price of M1 is 1 lakh. Because you are transferring M1, you will write here to machinery account. From machinery account, you are transferring M1. So machinery account will get reduced and a new account, asset disposal, is coming before us. Now if you will look very carefully, asset disposal account is having a debit balance of 1 lakh, and just prior to that we have credited provision for depreciation 45. What does it shows? It shows that M1 is having a cost price of 1 lakh on the date of sale and total depreciation till the date of sale is 45. So its book value must be 1 lakh minus 45, that is 55,000. Are you getting my point or not? This is the use of asset disposal. Before we pass the entry for sale, now we are in a position to compute. See here, book value of M1 on the date of sale. Book value of M1 on the date of sale. On the date of sale, book value obviously will be 1 lakh cost price less total accumulated depreciation 45. So 55,000 must be its book value. Is it clear to you? And you sold it for, you sold it for 50,000. So there is a loss of rupees 5,000. There is a loss of rupees 5,000. You are getting my point? So your entry for sale will be bank account debit 50,000. You are receiving 50,000. But there is a loss. You are receiving only 50,000, whereas the book value is 55,000. 2. Don't write asset account, because asset account is closed by transferring it to asset disposal, so you shall write to asset disposal account. Asset disposal account. So I solve this question through entries. I will also prepare the ledger. Correct? Now we are going to prepare the ledger account. Where is the scale? Let me have a sip of tea. Yes. We'll prepare machinery account as the question has asked. Machinery account. Besides, question has also asked us to prepare machinery disposal account and provision for depreciation account. So we shall now prepare provision for depreciation account, provision for depreciation account, and we will also prepare asset disposal account. Correct? So these are the accounts which we are supposed to prepare. Provision for depreciation account. And we will prepare asset disposal or machinery disposal account. In the first year, we purchased machinery. So entry is machinery account debit to bank. We have already written. So 1/1/2018, I will write here to bank. Correct? We purchased M1 on this date for rupees 1 lakh. Is it clear to you? Besides, what we did, now we reach the end of the accounting year. At the end of the accounting year, we pass the entry depreciation account debit to depreciation provision to provision for depreciation account. So in the provision for depreciation account, I will write here 31/12/2019 depreciation M1. It reflects this is depreciation on M1. Depreciation was 15,000. Correct? Then we passed another entry P&L account debit to depreciations. We are not preparing P&L or depreciation, so that entry will not affect these accounts. Now, as far as first year is concerned, task is over. Now we will balance it. As we know, machinery will be reflected at cost only. So 31/12/2018, balance carried down is 1 lakh. Correct? Then we will write here on 1/1/2019, to balance brought down. We will write here 1 lakh. Similarly, we will close provision for depreciation account. And provision for depreciation account, we will write here 31/12/2019, balance carried down 15,000. Then second year beginning 1/1/2000. Sorry, first year is 18. Extremely sorry. So on 1/1/2019, we shall write balance brought down 15,000. Now in the second year, we have purchased another machinery. That machinery was purchased on 1st of July 2019, machinery account debit to bank account. Yet another machinery was acquired, 1,50,000. Second entry, depreciation to provision for depreciation. At the end of the second year, 31/12/2019, we will write here by depreciation. Correct? We have provided depreciation in the second year on machinery 115,000 as I computed earlier. And on M2, 1,50,000 into 15% into 6 by 12, the amount was, we have written it, 11,250. We have done all these workings already. 26,250 is the total depreciation provided at the end of the year. So as far as second year is concerned, it is over. So balance now, we will write here 31/12/2019. You will write here two balance carried down. Balance carried down will be 15,000 plus 26,250, 41,250. 41,250, this is the balance. Of course, this balance will be brought down in the beginning of the third year, 1/1/2020. We shall write balance brought down 41,250. Correct? We will also close machinery account. At the end of the second year, machinery account is reflecting total balance at cost 2,50,000. There are two machineries, one M1, another one M2. Balance brought down, beginning of the third year, two balance brought down, 2,50,000. 2,50,000, M1 1 lakh, M2 150. Now in the third year, we again provide, at the end of the third year, the first entry which we passed, depreciation account debit to depreciation provision. Correct? So I shall write here by depreciation. Depreciation as we computed on M1 15,000 and on M2, how much it was? I forgot. 22,500. We have computed it already. 37,500. Correct? After this, we passed another entry. That entry was related to total accumulated depreciation on M1 now being transferred to asset disposal account. So our entry will be provision for depreciation account debit to asset disposal account. So we shall write here 31/12/2020 to machinery disposal or asset disposal account. Machinery disposal account. You are going to transfer the balance. But only total depreciation on M1, because M1 is being sold out. Don't transfer the entire balance. So we can easily see total depreciation on M1 15, 15 and 15, that is 45. In fact, we have already computed it, 45,000. Logically, provision for depreciation account reflects the total balance on the machinery which are still with the concern, which are still with the organization. So now only M2 is with us. So if I am going to balance it, the balance must be equal to 33,750. Why I am saying so, balance must be equal to 33,750. You can simply write balancing figure. Reason being is that now we are left up with only M2. And total depreciation provided on M2 is 11,250 and 22,500, which comes to 33,750. So now you are left up with only M2. So your provision for depreciation account will reflect the total depreciation on M2, because M1 now has been sold out. So whatever depreciation which you had created on M1 has now been transferred to machinery disposal account. So in the machinery disposal account, I will write 31st/12/2020 by provision for depreciation. I am writing in bracket M1, just to remind you that this is total provision for depreciation on M1. The next entry from the machinery account, the machinery which you sold out M1 is transferred to asset disposal account, and the entry you wrote asset disposal account debit to machinery account. Asset disposal account debit to machinery account. So machinery account will get a credit. 31st/12/2020, I will write here machinery disposal account. From machinery account, we are taking out M1 by transferring it to machinery disposal account. So machinery account will reflect the balance of the machinery now which is still with you. Only M2 is with you, and the cost price of M2 is 1,50,000. This is the entry you are going to pass, correct? Now this is machinery disposal account. In the machinery disposal account, as per this entry, you will write here to machinery account. Write in bracket M1. M1 you sold out and you transferred to machinery disposal account 1 lakh. So this account clearly reflects the book value of the machinery sold. 1 lakh minus 45. In fact, we have already computed that. So 55,000 worth of machinery was sold out for 50,000. You wrote the entry bank account debit, P&L account debit to machinery disposal account. So you will write here by bank. You sold the machinery for 50,000. You incurred a loss of 5,000, and now this account will get closed. This account will get closed. Correct? Now we are picking up a topic which used to be difficult, but in the light of AS 10, it has become almost like a walk in the park. So easy. Change in method. You should be thankful to AS 10 because it has simplified the things. Change in method. Change in method. Change in method. Now see, we have already seen that AS6 has been omitted and depreciation is now covered by AS10. AS6 is omitted and depreciation is now covered by AS10. We talked about it also earlier. AS10, that is property, plant and equipment. This is the title of AS10. Property, plant, and property, plant and equipment means tangible fixed asset. Property, plant and equipment. We call it PPE. As per AS10, remember we have already discussed AS10 separately in a separate section. When you will study AS10, you will see we have stressed on the provisions of AS10 very deeply and thoroughly. Correct? As per AS10, change in depreciation, change in depreciation method can be affected to reflect consumption pattern of tangible fixed asset TFA in a better manner. Indirectly, it means logically, depreciation method once adopted should not be changed. However, the consumption pattern, its uses actually keeps on changing according to the time. So if we find that our earlier method is not giving or fetching us the sort of results, then we may think of changing the method of depreciation to reflect the consumption pattern of the tangible fixed asset in a better manner. So that means AS10 allows a concern or organization to change the method. But what standard says, change can be effected. I have already written. Change can be effected, but prospectively, not retrospectively. Do you remember AS6? Accounting Standard AS6 used to stress that change in depreciation, whenever it is brought about, in that case we shall have to recompute the depreciation right from the beginning date. So now that particular part is over. So change can be effected, but prospectively. Prospectively means from future. Retrospectively means from the past. So that is why I said that it has become now easy. Further, AS10 also states, AS10 also states that change in depreciation method should be considered as change in estimate. Change in depreciation methods should be considered as change in estimate, whereas AS6 used to say that change in method should be treated as change in accounting policy. So now it is change in estimate. Anyway, so point here is that whenever in the examination, actually there are two questions in your module with respect to change in method. Unfortunately, those questions have been, the solutions of those questions have been given as per AS6, now which has been omitted. So your module must take what we call note of this particular point. Now change in method as per AS10, it means now the change will be brought about prospectively and not retrospectively. That means no recomputation of depreciation is needed as we used to do earlier. So my advice to the student, those two questions we have covered here, but we are going to cover those questions in the light of AS10. Whenever you are going to get the question in the examination of change in method, simply write the note also that question has been solved in the light of AS10. That's all. Correct? So we are picking up question number 7. Question number 7 of revised module. So question number 7, just have a look here first. A limited company purchased on 1/1/2018 a second-hand machinery, first-hand machinery, no problem, 12,000, and immediately spent, not sent, spent 8,000 on its overhauling. So total purchases will be worth rupees 20,000, 12 plus 8. On 1st July in the same year, additional machinery costing 10,000 is purchased. Then on 1/7/2020, machinery purchased on 1/1/2018 having become obsolete is sold for 4,000, and on the same date fresh plant is purchased at a cost of 24,000. So lots of purchasing, repurchasing, sale, disposal is taking place in this question. Depreciation is to be provided at 10% per annum on original cost on 31st of 12 of every year. That means accounting year is calendar year. In 2021, however, the company changes the method of providing depreciation and adopts the method of writing off 15% on diminishing balance. So in 2021, company decided to change the method of depreciation. Company moves over to written down value method from a straight line method. So this is the question. So not tough, let me make it clear. Not tough. Many students are under a phobia that such questions might be very tough. It seems very long. Where is my red pen? First of all, let me analyze the question first of all, because just reading is not sufficient. So whatever we have read, we are going to actually now present here. Now this visualizer is distracting me from having a look over the question. Limited company purchased on 1/1/2018. So we stretch a line first of all. Correct? Well, accounting year, this accounting year is starting from 1/1/2018, of course ending on 31st of 12/2018. Correct? As per the question, you purchased a second-hand machinery for rupees 12,000. M1 was purchased. I will call it first machinery. You purchased it for 12,000. You spent 8,000 also. So total cost is 20,000. Then on 1st July in the same year, so in the same year itself, on 1st July will fall somewhere here. On 1st of July 2018, yet another machinery, so I will call it M2, was purchased, and this machinery was purchased for rupees 10,000. Correct? Then on 1/7/2020, it means no new machinery was acquired in this year. In 2019, no new machinery was acquired. Correct? 1/1/2019, 31st 12/2019. No new machinery was acquired in this accounting year. Then we move over to the next accounting year. Next accounting year shall start from 1/1/2020, end on 31st of 12/2020. Isn't it or not? Then question says, just let me go through the question. On 1/7/2020, machinery purchased on 1/1/2018. Now question states that on 1/7/2020, machinery purchased on 1/1/2018, that means the first machinery. The first machinery is sold out here on this date. So on this date, the first machinery is sold out, having become obsolete, is sold for 4,000. So M1 sold on this date and sold for only rupees 4,000. Okay. And on the same date, fresh plant is purchased at a cost of 24,000. On this date, you are selling one machinery, and on this date, there is another thing. You are purchasing yet another machinery, and I will call it M3. M3 purchased for rupees 24,000. Of course, we are given that my company is charging depreciation at the rate of 10% on original cost, and in 2021 this is changed, and we move over to what we call, see, our depreciation policy till up to 2020 is 10% on a straight line method, and in 2021 we changed it to 15% on written down value. So this is the question. Question states that please prepare machinery account, correct? So question is asking us to prepare the machinery account. Logically, we are supposed to prepare machinery account only, and in this question it is stated. So if we are preparing only machinery account, that means depreciation is being charged to machinery account, correct? And if question would have asked us to prepare provision for depreciation, in that means depreciation is not directly charged to machinery account. How to solve such question? My advice to you: whenever lots of machineries are being purchased, correct, and lots of machinery are being sold, it is always better to make an analysis table. First step to solve the question: simply write title, computation of depreciation. Computation of depreciation. Computation of depreciation. Simply compute the depreciation, correct? You have at your disposal M1, you have at your disposal M2, and there is third machinery also, M3. Total 3 machineries. Now you write here the year 2018. In 2018 you purchased, as you can look into the table which I just drew out before you, correct? The analysis. I am looking at this analysis, and as per this analysis, on 1/1/2018 we purchased a machinery 20,000. So at the end of 2018 I will have to provide depreciation on it. So the depreciation on it will be 20,000 into 10% for full year, because we purchased it in the beginning, and depreciation is 10% on original cost, so it will be 2,000. We purchased another machinery, M2, but M2 was purchased on 1st of July. Cost price is 10,000. 10% is rate of depreciation, and for 6 months that will be equal to 1,000, then 500. So depreciation on this machinery will be 500. No depreciation on M3, because in 2018 we did not purchase M3. We come over to 2019. In 2019, again I am going to provide the depreciation on M1. It will be, of course, 20,000 into 10% original cost. I need not require to write again and again. You will provide depreciation on M2. Remember, now you have to provide for full year. 10,000 into 10% from the beginning of 2019 till the end of 2019. Depreciation 1,000. Still M3 is not purchased, correct? Now in 2020 we come over to, this is 2020. In 2020, first of all, see A. On 1/7/2020, we sold out M1. As you can see here in this table, on this date, 1/7/2020, we sold out M1, isn't it? Because we sold out M1, we need to provide depreciation on M1 from the beginning to the date of sale, from the beginning of 2020 to the date of sale. That means for 6 months. So depreciation on M1, 20,000 into 10% into 6 by 12, 6 months depreciation. From 1/1/2020 till 1st of July 2020, the depreciation will be 1,000. At least now you are in a position to know that total depreciation till the date of sale on M1 is 5,000. Total depreciation is 5,000 on M1, correct? But it is sold out on this date, but rest of the machineries are still with you. So when you will reach the end of 31st/12/2020, you will provide the depreciation on M2, and on M2 you will provide the depreciation for full year, that is on 31st/12/2020, 10%, 1,000. Besides, another machinery was purchased on 1st of July, that is M3. That machinery is purchased for 24,000. Original cost is 10%. And for 6 months you are compute the depreciation, isn't it or not? So depreciation will be equal to 1,200. Am I correct? So we can say we are left up with 2 machinery till the end of the accounting year, 31st/12/2020. Till 31st/12/2020, total depreciation on M2 I can say is 2,500, and total depreciation on M3 is only 1,200. This chart will help you in preparing machinery account in a quick fire manner. See here, now we can move over to preparation of machinery accounts. Second step. Second step. Machinery account. Now I will prepare machinery account. First of all, in the machinery account, on 1/1/2018, you write to bank. You purchased M1 on this date for 10,000. Before you reach the accounting year, you must remember that on 1/7/2018, you purchased yet another machinery. Sorry, this is to 20,000. Then you purchased yet another machinery for 10,000. Then we will charge the depreciation to the machinery account itself, because it is not asked to prepare provision for depreciation account. So 31st/12/2018, I will write the depreciation. I can straight away write depreciation 2,500. See here, 2,500. But if you want to reflect separately, that is on M1 2,000, on M2 500. So depreciation is 2,500. Correct? You can also write the balance carried down now. By balance carried down, you can straight away write the balance 30,000 minus 2,500, 27,500. But if you want to show the balance separately, then balance of M1 will be 20,000 minus 2,000, that is 18,000. And balance of M2 will be 10,000 minus 500, 9,500. Total 27,500 is still correct. Now we come over to the next year, 2019, 1/1/2019. We will write here 2 balance brought down. balance brought down is in the form of M1. M1 is having a book value of 18,000, correct? Besides, M2 is also having a balance. M2 is having a balance of 9,500. Remember, in 2019, we did not purchase any new machinery. So straight away we will move over to the end of the accounting year, whereby we are going to write 31st/12/2019. Again, we are going to write the depreciation. Time and again I have told you, you can straight away write the total depreciation, or you can simply show it separately. In 2019, on M1 depreciation is 2,000. On M2 depreciation is 1,000. You have also computed it, correct? So total depreciation is 3,000. Then you can write balance carried down. Balance carried down of M1. Could you let me know what will be the balance at the end of the second year of M1? See, book value is 2,000. Now 2,000 more depreciation, so balance will be 16,000. Similarly, balance of M2, 9,500 minus 1,000, 8,500. So total balance 24,500 in machinery account. We come over to the final year, in not exactly final year, but 31st/12/2020. Now we come over to year 2020. First of all, in the beginning of the accounting year, that is 1/1/2020. 1/1/2020. I will write here two balance brought down. We have machinery 1 having a balance of 16,000. We have M2 balance of 8,500. Before we reach the end of the year, we know that on 1/7/2020 something is happening. On 1/7/2020, you are selling your M1. So first of all, you need to provide depreciation on M1. You will write here depreciation on M1. We have already computed depreciation in the year of sale on M1 is 1,000. That is 20,000 into 10% into 6/12. Correct? Because you have sold it out, you need to know the book value. Book value is how much? 16,000. This is the book value before, in the beginning of the year. Correct? 16,000. Further depreciation of 1,000 has been given. So the book value, we can say, of M1 on the date of sale is 16,000 minus 1,000, that is 15,000. You can find it this way also, or simply you can look over here in this table. On the date of sale, you can find the book value also. See here, original cost of M1 is 20,000 less total depreciation. So total depreciation till date of sale. Till date of sale, total depreciation is 5,000. So book value on the date of sale is 15, we may say so. Correct? And that is getting reflected here also. 16,000 minus 1,000, its book value is 15,000. You are selling it for only 4,000. So you write here by bank, sale. You sold it for 4,000. 15,000 worth of item is sold for 4,000. So obviously there will be loss. Loss will be worth rupees 11,000. So with that, the story of M1 finishes. Correct? On 1/7/2020, you purchased M3 also. So you will have to mention it here to bank, M3. Correct? Now M3, how much you purchased it for? Sir, we purchased it for 24,000. Now, you reach the end of the accounting year 31st 12 2020. Now you will provide depreciation. You have two machineries, M2 and M3. M1 is sold out. Depreciation on M2 in the current year will be 1000, and depreciation on M3 we have already computed for 6 months, it will be equal to 1200. So we can find out the balance also now. Balance will be of M2 and M3. So balance carried down. Balance carried down. What will be the balance of M2? See here. 8,500 is the book value in the beginning of the current year. You have provided 1,000 worth of depreciation further. So 7,500 will be the book value of M2, sorry. M3, 8,500 minus 1,200. Sorry, 24,000 minus 1,200. M3, book value of M3 will be 22,200. 800 in fact. 22,800. Total balance is this, 7,500 and 22,800. Now, we will come over to this account is continued, correct, in the next sheet. Now we come over to 2021. First of all, let me write here 1/1/2021. I will write the balance brought down. Now we have only two machineries. One is M2 having a balance of 7,500, while another one is having a balance of 22,500, isn't it? 22,800. This is the balance. AS10 states that you can bring about the change in depreciation method, but that change will be effected prospectively. Prospectively means you need not require to do any past computation. Whatever has been done has been done. Correct? So in the current year, now all you have to do is to compute the depreciation as per written down value. That's all. So easy now. So 31st 12 2021 will provide the depreciation. Now depreciation on M2 will be 7,500. Remember, now we are not going to provide the depreciation on the original cost because depreciation method has been changed to written down value. So written down value is 7,500. We have to provide depreciation at the rate of 15%. So 7,500 into 15%, that will give you 1125. 1125. Then you will write M3. 22,800 is the written down value, that is book value, and now you will provide depreciation 15%. 22,800 into 15%, 3420. Now you will write balance carried down. By balance carried down. So balance carried down, M1 will have a balance of 7,500 minus 1125. 7,500 minus 1125, that is 6375. 6375. And M3 will have a balance of 22,800 minus 3420. 19,380. M3, M2 and M3. 19,380. If I will total it up, it will show the balance in machinery account. So this is how under change in method you have to solve the question. It is not a tough task at all. In simple words, whenever the change will be effected, only in that year you have to exercise a little bit of caution. After having completed question number 7th, of course we are going to pick up question number 8th, correct? My pen has fallen down, just let me pick it up. So just pay attention. X purchased a second-hand machinery on 1/2/2021, similar to the last question. In fact 7, 8 and 9 you can easily manage, to be very honest with you, correct? But anyway, We will cover this question also. X purchased a second-hand machinery, paid 11,000 for its overhauling and 5,000 for installation. Both these expenses will be added. 11,000 for its overhauling and 5,000 for installation, which was completed by 31st/3/21. Company provides depreciation at 15% on diminishing balance method. From the date it was put to use and closes its books on 31st of December every year. On 1/10/2022, a repair work was carried out on the machine and 5,000 was paid for the same. Remember one thing, you have carried out a repair. This expense is not in connection with bringing the machinery and installation. So don't consider this expense because you cannot capitalize this expense. This expense will be debited to P&L straight away. Correct? The machine was sold for 31st/10/2023 for a sum of 11,000 and amount of 1,000 paid as dismantling charges, prepare machinery account. Actually, this question, to be honestly speaking, this question does not belongs to the change in method category. Correct? First we will cover up this question. Now we have gone through that. It is not a change in method, but it's quite a question. Correct? So I will put this sheet here. I will analyze the question as usual. Question number 8. X purchased a second-hand machinery on 1/2/2021 for 50,000. Correct? And company provides depreciation and closes its books on 31st of December. So this is the situation. First year is 1/2/2021, so first year will begin on 1/1/2021, end on 31st of 12/21. Carefully note that machinery is not purchased on 1st January, it is purchased on 1st of February. Correct? This machinery you purchased, 50,000 is the cost. 11,000 you spent on its overhauling, besides 5,000 for installation. So all these expenses will be added. So 66,000 will become the cost, isn't it? And question also states that, please pay attention, this line is also important. You purchased the machinery on this date, but this machinery was installed on 31st/3/21. That means in the first year, when you are going to compute the depreciation on this machinery at 15%, you will compute from this particular date till this particular date. As you know, depreciation is computed from the period when the machinery is brought into use. So because machinery is installed on this date, we presume that it will be brought into use on this date. So you will compute the depreciation for this period, that is from 31st/3/21 till 31st of 12/21. That is means for 9 months. Correct? For 9 months you are going to compute the depreciation. The first line is important. Then what does the question says further? Company provides depreciation at the rate of 15% on diminishing balance method from the date it was put to use and closes the book on 31st of December. On 1/10/2022. Next year will start on 1/1/2022, and of course will end on 31st of 12/22. Isn't it or not? Question states that on 1/10/2022, you spent on repairs. Remember one thing, repairs will not be capitalized. It will not be debited to machinery account. It will be debited to repairs account only. Your entry will be repairs to bank and P&L account debit to repairs. It will not affect the machinery account. 5,000. Question also says that machine was sold on 31st 10/2023. Now we enter the next year. Next year will start on 1/1/2022, in fact 23, and end on 31st of 12/23. Correct? Question says that in this year, actually on 31st of 10, 31st of 10, 31st of 10, 2023, machinery is sold for a sum of 11,000. Machinery sold for 23,000. For a sum of 11,000, sorry. Machinery is sold for 11,000 and 1,000 was paid as dismantling charges. See, actually, dismantling charges you paid, you received a cash of 11,000. Dismantling means, dismantling is just opposite of installation. We install the machinery, correct, and when we are uninstalling it, it is known as dismantling. So even to uninstall the machinery, a machinery which has already been installed, if you are going to uninstall it, that is known as dismantling, and for that even we may have to incur some expenses for the same. That is known as dismantling charges. So when we sold the machinery, we had to dismantle it. So dismantling charges we paid. It means net selling price will be 11,000 minus 1,000. That is 10,000. Net you are receiving 10,000 only, correct? Then question states that prepare machinery account from 2021 to 23. 21, 22, 23 we have to prepare machinery account. Not a tough. It is not a case of change in method, but interesting. Correct? So I prepare machinery account. Where is the black pen? Okay, I will use the blue pen. I am not able to trace it. I am pretty unwell today, as so low on intensity. Correct? This is your machinery account. I think this is enough. Only one machinery is there, so no need to actually compute depreciation separately as I did. I told you that table you should prepare only when there are several machineries. Then only it is of use. Machinery account. First machinery is purchased. Look into the analysis which I just did. On 1/1 February 1/2/2021 you purchased a machinery, correct? So you will write here to bank. You will write bank 50,000 plus 10,000 plus 5,000, total 66,000. So cost of this machinery technically is 66,000, correct? Second, when you will compute the depreciation, you will reach the end of the year 31st/3/21, 31st/12. Calendar year is the accounting year. That's a problem. 31st/12/21, correct? 31st/12/21. We will write here by depreciation. Remember one thing, depreciation, why we are going to compute for 9 months, because machinery is not used from this particular date. Depreciation you are going to compute from 31st/3/21 to 31st/12/21. That means 9 months, correct? So 66,000 into, what was the rate in the question? I had skipped it. Depreciation rate is 15%. 8th question, no? Right. 66,000 into 15% into 9/12. So this is the depreciation. You will compute it this way. And depreciation will be 66,000 into 15% into 9 divided by 12. 7425 as per my calculation. You also check it down. 7425. 16,000 into 15% into 9 divided by 12. Yes, I have rechecked 7425. So this will be the balance at the end of the accounting year. So balance carried down, you will write here 66,000 minus 7425. Balance is 58,575. As far as accounting for 21 is concerned, that's over. We come over to 22. In the beginning, first of all, we will write on 1/1/22 two balance brought down. Balance brought down is pretty odd figure, 58575. 58575, correct? Now in this accounting year, what is happening? In this accounting year, first of all, question says you incurred an expense, but it will not affect the machinery account. You spent rupees 5,000 on repairs, it will be charged to what we call P&L account. It will not affect. Your entry will be repairs account debit to bank and profit and loss account debit to repairs account, correct? Then you will straight away reach the end of the accounting year, 31st/12/22. Once again, you are going to provide the depreciation. This time depreciation is on written down value in this question. So written down value is 58,575. You will compute depreciation 15% into 15%. That comes to 8786 approximately. 8786, correct? I have appropriated it. So now you will compute the balance carried down. The balance carried down will be 58,575 minus 8786. That gives you 49,789. This is your balance. Now you write here 1/1/2023, balance brought down 49,789. As we know, on 31st of October, so 31st/10/2023, we sold this machinery, so we need to compute depreciation. Of course, we will compute the depreciation for 10 months, from 1/1/23 till 31st of October, correct? So depreciation will be computed on written down value 49789 into 15% into 10 by 12. For 10 months depreciation you need to compute. So into 15% into 10 divided by 12, it comes to, according to my calculation, 6224 approximately. 6224, correct? 6224. Is it clear to you? Unfortunately, question states that we sold the machinery only for 11,000. So I will write here by bank. Sale see here, actually sale is 11,000 less dismantling charges, because dismantling charges on sale will reduce your sale amount. $1,000. So that means total is actually 10,000. Your net selling price is only 10,000. Of course, there is a big loss in this question. What is the book value on the date of sale? You subtract this figure from this one. 49789 minus 6224. That is 43,165. The difference, this is book value in the beginning, this is depreciation till the date of sale. By subtracting this figure from this one, I am getting a figure of 43,165, and our net selling price is 10,000. So whatever balance we are left up with now, I will subtract 10,000. This is 33,165. So this is how this question will have to be done. Not a tough question, but there are two important points. Also, when you solve, suppose this question strikes in the examination, don't forget to write in the note that repairs expenses are of revenue nature and will be charged to P&L. Repairs expenses of rupees 5,000 will be charged to P&L. It will not be charged to machinery account. Will be charged to P&L. Correct? You must take care of this thing to supplement your solutions with proper notes that helps the examiner regarding the treatment which you have adopted. Well, we'll pick up another question. Of course, this question is of change in method. Neha Limited purchased a machinery on 1/1/2020. It spent on its overhauling 40,000. Another machinery was purchased on 1/7/2020 for 80,000. On 1/7/2022, machinery purchased on 1/1/2020 was sold for 1 lakh. On the same date, another machinery was purchased 30,000 but installed on 30th of 9/2022. Under the existing practice, the company provides depreciation at 10% or original cost. However, from 2023, it was decided to adopt written down value, correct, and depreciation rate will be 15%. We have to prepare machinery account from 2020 to 2023. First of all, it is always better to analyze the question, as I keep on saying so often. Correct? This is question number 9. First, we'll analyze this question. Correct? In this question, what is happening? On 1/1/2020, a machinery is purchased. So 1/1/2020, we purchased M1. I will call it M1 for 1,60,000. I spent rupees 40,000 on its overhauling. Not only this, we also purchased another machinery on 1/7/2020. So midway, that is on 1/7/2020, we also purchased another machinery, and that is M2, I will call it. M2 has been purchased for rupees 80,000, isn't it? Obviously, your accounting year will end on 31st of 12/20. Then we move over to the next year. However, the next year is not influenced by any sale or purchase. In the next year, what I mean to say is that, which is starting from 1/1/21, ending on 31st/12/21, in this accounting year, neither you purchased any asset nor you sold any machinery. We move over to 22. In this accounting year, something is happening. 1/1/2022, 31st of 12/22. In this accounting year, it is given to you on 1/7/2022. 1/7/2022. 1/7/2022, the machinery purchased on 1/1/2020, that means M1. So question is saying that on this date, M1 sold. How much for? M1 was sold, question states, for rupees 1 lakh. Sold for rupees 1 lakh. Besides, on the same date, another machinery was purchased and installed. Question stylishly says, on this date, we also purchased another machinery. Obviously, I will call it M3. M3 acquired or purchased. It is purchased on 1/7/2022 for rupees 30,000. For rupees 30,000. However, this machinery, third machinery, has been installed on which date? On 30th 9. 30th 9. So you have to keep track of this particular point, that when you will compute the depreciation, first of all, when you will compute the depreciation in the year of sale on the machinery which has been sold out, that will be for 6 months, correct? Time period from this particular date till particular date is 6 months. You will compute the depreciation for 6 months. However, this machinery, even though you have purchased it on 1/7 of 2022, in spite of that, you will have to compute the depreciation from this particular date till this particular date. That means only for 3 months. So these are the points which you need to keep in your mind. What else question says? Your depreciation policy, present depreciation policy is 10%. Present depreciation methodology actually is 10% on original cost. 10% on original cost. However, company decided to change it from change the depreciation from which date it is 23. So from year 23, that means from next year, this policy has been now changed to 15% on written down value. So this is the question, and you are being asked to prepare machinery account, correct, in the books. Generally, you will be asked to prepare machinery account, correct? So this is how you will have to do this question. In fact, this is the way you have to move about this question. So in this question, let me frame first of all machinery account. But before that, since there are lots of machineries involved, so my first step should be to calculate depreciation separately. Calculation of depreciation. Calculation of depreciation. When several machineries, or honestly speaking, when more than one machinery is involved, it is always better to separately compute, although not a necessity. Calculation of depreciation. But it helps in feasibility. It makes the things easier. Calculation of depreciation. How many machineries are involved? So 3 machinery. M1, M2 and M3. So we will compute the depreciation first of all for year 2020. We will reach the end of the accounting year. In this year we have machinery 1. Where is the question? I am not able to see the question right now. On 1/1/2020, first machinery is 160 plus 40, 2 lakh. So 2 lakh into 10%. So your depreciation will be 20,000, isn't it? In this year you have purchased another machinery. This machinery has been purchased for 80,000. You will compute the depreciation, but for 6 months, because you acquired this machinery on 1st of July. So it will be equal to 4,000. No question of providing any depreciation on M3 in year 2020. We move over to year 21. In year 21, no purchases and sales have been made. So depreciation on M1 will be how much? Depreciation on M1 will be 2 lakhs into how much? Just hold on. Sorry. So we are talking about year 21. In year 21, as you can see, No purchase and sales have been made. So simple, I'm going to compute the depreciation for the entire year on machinery M1, that will be 20,000. Then on this machinery, I will have to compute the depreciation on 80,000 for entire year. That will be 8,000. And we haven't yet acquired M3. We move over to year 22. In year 22, what is happening? Year 22, as you can see in this year, first of all, let me check it out here. On 1/7/2022 is the date of sale, in fact, for M1. We sold out one machinery, M1, on 1st of July. So depreciation on M1 will be computed till up to 1st July. That means for 6 months. So 2 lakh into 10% into 6/12. So that is equal to 10,000. Correct? This depreciation is being computed on 1/7/2022. Now, after the sale of M1, we shall be left up with M2 and M3, and depreciation on M2 and M3 will be computed at the end of the year, 31st of 12/22. So depreciation for this machinery will remain same, 80,000 into 10%. That is equal to 8,000, isn't it? And depreciation on M3, because now you have acquired M3 also. M3 was acquired on 1/7, but remember it was installed on 30th of September. You have to compute the depreciation for 3 months. Now, in this case, cost of M3 is 30,000 into 10% into 3/12. So this will be depreciation on M3. That will be equal to 750, I think so. So 3,000 divided by 4, yes, 750. So 750 will be depreciation on M3. Is it clear to you or not? Because we sold out machinery M1, so we may say total depreciation on M1, as you can see, is 50,000. So you can also compute the loss and profit also. Loss profit on sale of M1. In order to compute loss and profit, we need to know the book value. Book value of M1 will be, original cost is 2 lakh and total depreciation till the date of sale is 50,000. So we may say book value on the date of sale is 1,50,000. Sold for. Sale price. What is the sale price of this machinery? 1 lakh. Sale price is 1 lakh. So you can see there is a loss of 50,000. So loss of 50,000 you incurred on M1. Is it clear to you? And from 2023 you will have to change the method also. So not very tough, as I said, especially in the light of AS10. Correct? This is my machinery account. Machinery account. In the machinery accounts, towards the debit side, first of all, you will write here on 1/1/2020. You will write here to bank. You purchased machinery M1 and total cost is 2 lakh. Besides, in this year, you also purchased another machinery, don't let it skip, 1722 bank. This machinery you purchased for 80,000. M2, 80,000. Then you will move over to the other side at the end of the accounting year, 31st/12/2020. You will charge the depreciation. You will write here depreciation. On M1, we have already computed depreciation is 20,000. And on M2, depreciation as per the calculation of depreciation table, which we just framed, 4,000. Correct? Then I will write here balance carried down. Balance carried down. M1. Balance of M1 will be 2 lakh minus 20, 1,80,000 at the end of the first year. Balance of M2 will be 80,000 minus 4,000, 76,000. So as far as first year is concerned, things are over. We move over to the next year, 1/1/21. We will write here 2 balance brought down. When you will bring the balance, you have machinery M1 having a book value of 1,80,000 and M2 having a book value of 76,000. Then you move over to the end of the accounting year. In this accounting year, no purchases, no sale are there. You will simply provide the depreciation at the end of the year. You have already computed depreciation. You can look over there. On M1, the depreciation is 20,000 and on M2, depreciation is 8,000. So now you will compute the balance also, correct? So you will write here balance. So balance carried down. Now balance of M1 will be 180 minus 20, that is 160. And balance of M2, as you can see, 76 minus 8, that will be how much? 68. Right. So now accounting for second year is also over. We come over to 1/1/2022. First we shall write here 2 balance brought down. Balance brought down is 68, balance brought down M1, because we are writing separately, 1,60,000 is the balance. M2 balance is 68. In this accounting year, on 1/7, as you can see, 1/7, where is the analysis table? Right, on 1/7/2022, you purchased another machinery, M3. M3 was purchased for, I just skipped, for how much? You purchased it for rupees 30,000, correct? And don't forget, you have purchased it on 1/7/2022, but it has been installed on 30th September 2021-22, right? Let me check the date, whether I have written the dates correctly. Right, 30th/9/22, correct? Now, importantly, on 1/7/2022, you sold out M1. So, because you sold M1, you will charge the depreciation on M1. Depreciation on M1 will be for 6 months in the year of sale, which we have already computed. It is 10,000. Even though we have done the working, we don't need that. Even from this particular account, we can infer what exactly is the book value. 160 minus 10, 150 is the book value on the date of sale. Correct? And we sold it for 1 lakh. So I will write here buy bank sale. We sold it for 1 lakh. So obviously there is a loss of 50,000. 150 worth of item going out for 1 lakh. Now we reach the end of the year, 31st 12 22. We are left up with two machineries, M2, M3. We have to provide depreciation on it. So depreciation on M1, M2, sorry. Depreciation at the end of the year on M2 will be 8,000 and on M3 will be for 3 months, that is 750. And now we are in a position to compute the balance carried down. So balance carried down of M2 will be 68 minus 8, that is 60,000. And balance of M3 will be 30,000 minus 750, 29,250. So these two machineries are with us till the end of the 31st 12 22. Correct? Now, One 2023 final year. First of all, we start by writing balance brought down. Balance brought down for M2 is 60,000. Balance brought down for M3 is 29,250. We have changed the depreciation methodology, 31st 12 23. However, it is not going to bring any hiccups. Only thing is that now we'll provide depreciation on written down value. So we'll provide depreciation M2, that is 60,000 into 15%. Now rate is 15%. 60,000 into 15%, 9,000. We will provide the depreciation now on M3. 29,250 into 15%, that comes to 4,387 approximately. So balance is left at the end of 2023 for M2 will be 51, 60 minus 9, and for M3 balance will be 29,250 minus 4,387, that is 24,863. 24,863. Correct? When you solve this question, you should write it out, not over here because I am lacking the space, but as per AS10. So you write below that question has been solved as per AS10, so that there is no confusion in the minds of the examiner. Correct? Because AS6 gives a different treatment and we are going to abide by AS10 because this is now what is prevailing in the accounting field. So after having completed till up to 9th, moving over to 10th question. Correct? It's an interesting one, just pay attention. Sunshine Limited expects that a plant has become useless, which is appearing in the books at rupees 20 lakhs of gross value. So one plant is there which you must have purchased for rupees 20 lakhs. Gross value always means original cost. But now company is feeling or concern is thinking that this particular plant has become useless. That means it should be now retired, of course, because it has become useless. The company charges straight line method depreciation on a period of 10 years. Estimated life and estimated scrap value is 3%. So when you had purchased the plant, you were under the impression that it would serve you for 10 years and after that still the plant would have a scrap value of 3%. 3% means 3% of original cost, which is 20 lakhs. At the end of the 7th year, plant has been assessed as useless. Now, after 7 years, it was found that this plant has become useless, even though you had earlier visualized that this plant would serve you for 10 years, but when you made and sorry, extremely, when you made a reassessment, then you thought, now you came to know that its life is just 7 years. It is estimated that net realizable value is 6,20,000 and you are estimating its realizable value will be 6,20,000. Determine the loss or gain on retirement of the fixed asset. So basically this question belongs to AS10, to be very honest with you. Correct? Even AS10 covers the part of the depreciation, as I have already told you. See, actually, as per AS10, if any property, plant and equipment or asset which becomes useless, indirectly it means which is now retired from the business use, and you are holding it for the purpose of disposal, of course, then it should be reflected in the books at a lower of book value or net realizable value. If you want me, I will write it for you. Question number 10 we are picking up. Right, as per AS10, any item of property, plant and equipment, PPE, that is tangible fixed asset, that have been retired from active use and held for disposal. Now you are holding simply for disposing it off. Disposal. So if any item or property, plant that has been or that have been items that have been retired from active use and held for disposal, then standard says should be stated. Stated means should be reflected in the books, should be stated in the books. In the books means in the balance sheet. In the books at lower of net book value. Net book value simply means book value, and NRV, net realizable value, NRV. So if you have retired any plant or you are finding that a plant has become useless, then at what value you should reflect it? You should reflect it at a lower of book value or NRV. Further, any expected loss, because as per principle of conservatism, conservatism means expected things. So we need to actually recognize the expected losses. Any expected losses should also be recognized. Should also be recognized. Should also be recognized. Now in this question, I will tell you the story, what exactly the question is. Actually, let us say you purchased a plant here for rupees 20 lakhs. And when you purchased the plant, you were under the impression that it will have a life of 10 years. And you estimated its scrap value as 3%. And Depreciation method you adopted a straight line method. Correct? Now, this is the main solution. In fact, main solution I have already started. This is practical part. Could you tell me what is the cost? Cost is 20 lakhs. Gross value always means original cost. Scrap value or estimated realizable value, scrap value given to you as 3%. So 3% of 20 lakhs will be equal to 60,000. Correct? If I will deduct scrap value from the cost, technically it is known in accounting language as depreciable amount, because this is the amount which you need to depreciate. Depreciable amount. It is known as depreciable amount. Correct? So this is the depreciable amount. Now if I am going to divide it by 10 years, it will give me depreciation per year. So depreciation per year is equal to this much. As per your original estimation, your depreciation per year is 1,94,000. But what is happening at the end of the 7th year? At the end of the 7th year, you made some reassessment and you found at the end of the 7th year, you found this plant has become useless. So because this plant has become useless, you have to retire it from the active business use and ultimately you will have to sell it. Now, at the end of the 7th year, first of all, I need to find out the book value. In order to find out the book value, how can I find? Depreciation per year is 1,94,000. We know. Correct? B. Once again, I will write cost. Cost is 20 lakh. Because I am interested in knowing total depreciation till 7th year, less total depreciation for 7 years. So what will be the amount of total depreciation? Because your per year depreciation is 1,94,000. You multiply it with 7. How much it will be? I will take the calculator. 1,94,000 into 7, that gives 13,58,000. So total depreciation in the last 7 years is 13,58,000. By subtracting this amount from the original cost, you will have the written down value after 7th year. This is written down value or net book value after 7 years. So that will be equal to 6,42,000. 6,42,000. So now you know the written down value. Step C. I have already written that as per AS 10, if any plant becomes useless, then it should be reflected in the books at lower of. So, book value is 6,42,000 and estimated realizable value, it is given in the question that you expect this plant to be realized for 6,20,000. It is given in the books. So, in balance sheet, plant will be reflected at 6,20,000 because lower value is 6,20,000. This is what AS 10 states. Will be reflected at rupees 6,20,000. AS 10 also states that any loss will also be recognized. So, loss of difference of these two, 22,000. Loss of 22,000 will also be recognized in the P&L. Shall be recognized in P&L. Is it clear to you? Shall be recognized in P&L. So you are going to recognize this loss in your P&L also. This was question number 10, and to be very honest with you, question number 11 is absolutely same. It is solved, so you can do it by yourself. Correct? Question number 11, you can do it by yourself. Question number 12, what does this question states? Question states that a company has purchased a plant and machinery in the year 1920 for 90 lakhs. A balance of 10 lakh is still payable to the supplier for the same. The supplier waived off the balance amount during the financial year 22-23. The company treated it as an income and credited to profit and loss account during 22-23. Whether accounting treatment of the company is correct, if not, state the reason. Correct? What exactly is the question? First of all, let me explain this. Question is that sometime back in 2019 and 20, you bought a plant for 20 lakhs. Correct? You bought a plant for 20 lakhs. But till, because the date given in question is 22-23, so till 22-23, balance amount is still payable. You are still supposed to pay balance 10 lakhs. That means at that time when you bought the plant, you must have paid 10 lakhs. That is why question is stating that till 22-23 balance 10 lakh is still payable. Now what happened? Supplier from whom actually you purchased or acquired this machinery, he waived off this 10 lakhs. Waived off means he simply told us you need not require to pay. We do not know what exactly possible is the reason, but due to some or other reason, supplier waived off. So supplier told us we need not require to pay. So what our company did actually, our company thought that we were supposed to pay 10 lakh and now we need not require to pay 10 lakh. So we should take it as an income. Now the question is asking whether the treatment met by company is correct or not. Correct? So treatment by company, first of all let me write, this is the solution. This I have already told you, this is standard based question. As per AS 10, I told you we will cover the standard based question also. As per AS 10, the cost of PPE. PPE means tangible fixed asset may undergo changes subsequent to acquisition subsequent to acquisition of PPE. Indirectly it means once I have purchased a plant, it could be a possibility that its original cost may change due to price fluctuations in the market or due to waivers or due to any other reason. So price of a property, plant and equipment may undergo a change. But standard says that if there is change, that change should be adjusted in the cost and it should not be taken to P&L. So in the present case, treatment is incorrect because company took that waivement, the amount which was waived, company took that to P&L. In the present case, treatment met by company is incorrect. Incorrect, as amount waived should be adjusted in as reduction in cost. That means instead of taking it as an income, you should use it as reducement in cost, correct? Should be adjusted as reduction in cost. In simple words, if after the acquisition price of PPE gets affected due to subsequent changes, that those changes should be adjusted in the cost and not in the what we call P&L. So this is your question number 12, correct? Now similarly, there is question number 13 also. Question number 13, interesting question, again is standard based question. P13 Limited purchased a car on 1/4/2017 for 18 lakhs from a supplier who normally offers 3 months credit facility. However, P3 Limited acquired it under an agreement whereby it would pay the amount of the car after a period of 2 years. Presume the borrowing rate as 10%, show the amount of cost of car. Now, first of all, let me explain the question as usual. Question number 13. This was question number 12, and now we are picking up question number 13. In this question, what exactly is the situation? P13 Limited actually acquired a car. You acquired a car, correct? Normally, the supplier from whom car is being purchased, that supplier normally gives 3 months credit facility. That if today you have bought the car, within next 3 months you are supposed to pay. But we bought the car today and we told to the supplier that we are going to pay you after 2 years. We are not going to pay you today. We bought the car today, correct? And we told him that we are going to pay this amount after the end of the 2 year. In fact, the first year will end here and second year will end here. I did not require to stress this line, correct? And the amount which is bought for is 18 lakh. Car amount is 18 lakh. This is the situation. Now, as per AS10, correct? If we get a credit facility which is in excess of the normal credit facility, normal credit facility is actually 3 months, but here we are getting a time period of almost 2 years. So after 2 years, we are going to pay 18 lakhs. Suppose I give a loan to you today, 18 lakhs, and after 2 years, if you pay me back 18 lakhs, do you think in real terms you have paid me 18 lakhs? No. In fact, now the value of 18 lakh after 2 years will be lesser than what it was 2 years ago. So, keeping that thing into account, standard also says that whenever any property, plant and equipment is bought on a deferred credit period basis, in that case, the amount which you are paying after 2 years, correct, contains some interest element. So, what will be the amount of the cost of the car in real terms, we will have to find out. And how can we do so? See here, you first of all write here cost of car shall be cash price equivalent. What does it mean? Cash price equivalent. cost of car will be cash price equivalent. Technically, if I'm paying you 18 lakhs after 2 years, correct? I should have paid 18 lakhs here on the first day of the first year. But I did not pay anything to you on this date, rather after 2 years I'm paying you. That means if I'm paying 18 lakh in 2 years, logically this 18 lakh is, which I am paying to you here, is not equal to this amount. So what my point is, I will be able to explain it once. Let me actually go through the calculations. See here how to determine. In your financial management, you have done it lots of time. You will compute the present value, correct? In order to compute the present value, what we will do, cash price equivalent shall be, cash price equivalent basically here means cash price equivalent is nothing but present value of rupees 18 lakhs. Present value of 18 lakhs at 10% for 2 years. That means we need to find out the present value. See here. How can we do so? Actually, if such sort of question strikes, then you will always be given present value factors. Don't worry about that. So we can compute in this case this way around, 18 lakhs into, I will compute present value factor at 10% for 2 years, and that will be equal to 0.826. Each one of you are aware of it, present value factors, correct? In the column of 10%, you will look, first you look into the 10% column, then in the row of second years, correct, you will find 0.826, and it is nothing new. Each one of you are aware of it. So it is equal to 14,86,000. It means logically 14,86,000 on this date is equal to 18 lakh which you are paying on this date. Logically, it means if you had purchased the car on, if you had paid the amount on the date on which you purchased the car, logically it means 14,86,000 is the cost price of the car, but you are now paying 18 lakh. So the difference will be considered as interest in the eye of the standard. Is it clear to you? The difference will be, so cost of the car will be treated as 14,86,000, and the difference of 18 lakh, difference of 18 lakhs, difference of 18 lakh minus 14,86,000, that is 3,13,200, shall be treated as interest, shall be treated as interest. You are going to treat it as interest. This is what standard states. That means standard in simple words means whenever we buy any what we call property, plant and asset on deferred terms, in that case the payment which we are making contains some interest element, so we have to find it out, correct? So this is also standard based question, no doubt about that. We pick up another question, question number 14. Question number 14. Question number 14 actually deals with, we will see here what exactly it deals with. It deals with reassessment of life. It is nothing new. Y 555 Limited acquired a machinery for 1,20,000 having an useful life of 10 years with zero residual value. At the end of the third year, it was reassessed that machine is useful only for 5 more years, correct? Calculate the depreciation for the 4th year and onwards. So First of all, in this case, there is reassessment of life. Reassessment of life. Reassessment of life, what does it mean? I will make you understand. See here. Y555 Limited bought a machinery for 1,20,000. You bought a machinery for 1,20,000. When you bought this machinery, you thought its life will be 10 years. Just a moment ago, and at that time, you also thought that its residual value will be 0. When you purchase the plant, at that time, estimation before you is that life will be 10 years and residual value will be 0. But you made a reassessment in the third year. At the end of the third year, it is common practice among the concerns. They keep on assessing and reassessing, as I said earlier also. So they made a reassessment at the end of the third year. Let me pick up the scale also. At the end of the third year, company made a reassessment. Because often concerned feel actually, let us reassess the life. So they made a reassessment, and what they found, when they reassessed, they assessed that life remaining is not 7 years. Rather, life remaining is just 5 years. Remaining life is 5 years. Now question is asking us to compute depreciation for 4th year. So it is not very tough. See, first of all, depreciation per year. Originally, when we bought the plant, we knew that, in fact, we assessed that cost is 120, but residual value will be 0. And we also made a assessment of life equal to 10 years. So our original depreciation per year must be 12,000, isn't it? Now, depreciation for 3 years. If I will ask you, depreciation for 3 years, you will tell me 12,000 into 3, 36,000. So that means during 3 years, I must have charged 36,000 worth of depreciation. Book value after third year. What will be book value after third year? Book value after third year is how much? Cost of the plant is 1,20,000. And during these 3 years, total depreciation is 36,000. So we may say at the end of the third year, value is this much, 84,000. This is the book value. So whenever life is reassessed, first of all, we need to compute the book value when the reassessment is made. Reassessment is made at the end of the third year. So at the end of the third year, we may say book value is 84. And we will have to compute the revised depreciation. So revised depreciation now, that means revised depreciation means for the next 5 years, per year depreciation will be how much? So revised depreciation will be revised depreciation per year. $84,000 now you will consider as the revised cost, or it is also known as revised book value. Scrap value is still 0, but remaining life is 5 years. So that means depreciation for the next 5 years will be equal to rupees 16,800. So depreciation for 4th year, 5th year, 6th year and 7th year and even 8th year will be 16,800. 16,800 per year, correct? So this question this question is related to, as I said, what we call it question number 14A, in fact, because there is one more question having a numbering of 14, and even question number 14B is on similar lines. Z Limited purchased a machinery for 1,20,000 having a useful life of 10 years with zero residual value at the end of the third year. Due to price adjustment, the cost of the machine is increased by 6,000. Also, it was reassessed that machine is useful for further 9 more years, after which it could fetch 9,000. See here, in this question, there is reassessment of life and there is some other adjustment also. Even in this question, you bought a machinery for 1,20,000 initially, and your original impression is that machine will have a life of 10 years, and your original impression regarding scrap value is that after 10 years it will have nil value. These are your original impressions, means when you originally bought the machinery. Now question says, at the end of the third year, due to some price adjustments, the cost of the machinery is increased. Just a moment ago we did a question. So once we bought the asset, sometime the price of the asset fluctuates due to some or other reason. That adjustment must be reflected in price. So this time price increased by 6,000. Price increase is there by rupees 6,000. And we also estimated, actually 3 years have gone by. So technically, as per our original estimates, 7 years should be remaining. But we reassessed that after third year, when we made the reassessment, we assessed that still 9 years of life is remaining. Still 9 years of life is remaining. 9 years of life is still there. So in this question, there are two things, correct? So similar to the last question, we will solve this question. First of all, let me compute the original depreciation, correct? See, we can compute the depreciation directly. You should now learn this art also. First of all, write the cost. Cost 1,20,000. Straight away write depreciation for 3 years. Depreciation for 3 years. You can compute. 1,20,000 is the cost. As per your original estimates, the scrap value is 0 and life is 10 years. So it means per year depreciation is 12,000. Multiply it with 3 and you will get 36,000. Correct? So we may say net book value after third year is 84,000. Now, in this case, before you compute the revised depreciation, first you will have to compute the revised net book value. For the same, you are going to add what? Price increase. Price increase. It has been given that price has gone up by 6,000 at the end of the third year. So for the purpose of revised depreciation, revised book value will be considered as 90,000. This is your revised book value. So revised book value is 90,000. Correct? Now remaining life, and it is also adjusted that machine will have a life of 9 more years, after which it will fetch 9,000. So revised book value is 90,000. First you subtract less estimated realizable value or scrap value. Estimated scrap value or realizable value. It is given that after 9 years, this asset can be sold for rupees 9,000. So that means net revised book value will be considered 81,000. Net revised book value. This net revised book value is having a life of 9 years divided by 9. So you will get the depreciation not only for the 4th year but rather for each of next 9 years. So depreciation per year that is 4th year and onwards. 4th year and onwards. Fourth year and onwards. So how much it will be? That is 81,000 divided by 9. So each year you are going to provide depreciation 9,000. For the next 9 years, per year depreciation will be 9,000 each. Is it clear to you? Welcome again. Now we are picking up question number 15, correct? Actually, I just started and then stopped the class. That is why you are finding it written something over here. Question number 15, I'm simply going to analyze the question. I'm not reading the question. You can read the question, correct? However, you will not have any what we call problems because we have done now so many questions. There is a concern which purchased a machinery for rupees 12 lakh, and when it was originally purchased, company estimated the life to be equal to 10 years. Besides, company also estimated a residual value equal to 2 lakhs. Equal to 2 lakhs. Correct? These are original estimates. At the end of the 3rd year, sometimes these things fall down and creates problem. At the end of the 3rd year, what is happening? At the end of the 3rd year, honestly speaking, that is in between 3rd and 4th year. So whenever it is written in between, always take the year earlier as the end of the year. For example, suppose if I gave you in between 7th and 8th year, take end of 7th year. This time it is written in between 3rd and 4th year, so I will consider it end of the 3rd year. At the end of the 3rd year, what happened? Machinery was revalued and it was found there is an upward revaluation. There is an upward revaluation. Upward revaluation. Upward revaluation was to the extent of rupees 3 lakhs. Correct? Besides, at the end of the 3rd year, it was also estimated that machinery will have a remaining life of 10 years. Machinery will have a remaining life of 10 years. That means after the end of the 3rd year, still there will be 10 years left. Also, it was estimated that at the end of the 3rd year, at the end of the 10th year, this will also have a residual value of 3 lakhs. So there are lots of changes now in this case. So how to go about the question? First of all, what we are going to do, we are going to find out at the end of the 3rd year the book value. That should be our first task. A. Let me write original cost. Original cost, as you know, is actually 12 lakhs, isn't it? Original cost is 12 lakh. Then you subtract the depreciation. Less depreciation for first 3 years. Depreciation for first 3 years. Depreciation for first 3 years will be equal to how much? Original cost is 12 lakh. As per your original estimates, residual value is 2 lakhs. As per your original estimates, your life is 10 years. So per year depreciation will be 1 lakh. You multiply it with 3. So you will get 3 years of depreciation, which will be equal to 3 lakhs. So now you get the depreciation equal to 3 lakhs, correct? By subtracting the depreciation, you get the book value. So book value now is equal to 9 lakhs, correct? At the end of the third year, you got it revalued, found upward revaluation. So you add upward revaluation. Upward revaluation 3 lakh. You add it. However, there is also estimation that machinery will have a residual value of 3 lakh. You subtract 3 lakhs. So by adding upward revaluation and subtracting the revised estimate of what we call a residual value 3 lakh, what we get now, we get net book value. This is net revised book value. Net revised book value will be again 9 lakh. We will add 3 lakh, we will subtract 3 lakh, we will left up with 9 lakh. Now we shall divide it by 10. Remaining life. After the end of the third year, still there is remaining life of 10 years. Isn't it? By subtracting 10 years, we get 90,000. Now this will be considered as our answer, depreciation for fourth year and onwards. Depreciation for fourth year and onwards. So this was the question. We have done such sort of questions. Now, besides, you have question number 16. It's a theoretical question. We have already done this question. What this question number 16 is all about, it's a theoretical question we have already done, to be very honest with you. In this question is simply asking us if a concern changes depreciation method, then what happens? If you remember, we have done this question. Earlier we wrote changes can be brought about. Changes in depreciation method. Changes in depreciation method can be brought about as per AS10. As per AS10, changes can be brought about to reflect better consumption pattern. To reflect better consumption pattern. Correct? This is what we have already written. This is a theoretical question. However, such changes should be effected prospectively. Should be effected prospectively. So if a firm will change its depreciation method, question is asking, what does AS10 states about? So changes can be brought about, but changes can be effected prospectively, and such changes should be considered as change in estimate, should be considered as change in estimate. Hardly 2 marks question. Because AS10 states that such changes should be considered as changes in estimate, correct, rather than changes in accounting policy, which was suggested by AS6. Question number 16, then we pick up question number 17. Again, it is a theoretical question. Question number 17 is that actually an entity purchased a particular asset, in this case a bus, and company did not provide any depreciation. So as a statutory auditor, what will you do? Question is simply asking us, what will you do? Hardly 1 mark question. I have already told you that depreciation, since depreciation also takes place, on account of what? On account of effluxion of time, that is passage of time. So even though if you haven't used the bus entirely for the year, that doesn't mean that bus will not get depreciated. So since depreciation also takes place on account of effluxion of time, comma, depreciation must be provided on the bus. Correct? So contention of the company is wrong. Contention means what the company is claiming. Contention of the company not to provide depreciation is incorrect. In the light of AS10, correct? This is how you have to write. Then question number 18 is related to what we call a question which is of change in method. I will explain the question, you will get, don't worry about that. Question number 18. What does this question states? Question number 18 states that a company acquired a machine on 1/4/2016 for rupees 5 lakhs, and it also estimated its life equal to 10 years, and also estimated that its scrap value will be 50,000. Correct? From 2019 and 20, that means after accounting year is starting on 1/4/2016, then we will reach 31/3/2017, then we will reach 31/3/2018, then we will reach 31st/3/2019. So question is stating that in this year company changed the method. In this year, that is 1/4/2019, 31st/3/20, in this year method change, and company decided to adopt new method of 20% on written down value. So no problem. We will till up to third year, first of all we will compute the written down value, and at the end of the fourth year we will give the depreciation at the rate of 20% of written down value. Simple, no problem. You can do it even by yourself, but still if you want me to do, I will do it for you. See here, original cost is how much? Original cost is rupees 5 lakhs, isn't it? Rupees 5 lakhs. Scrap value. Originally you estimated scrap value equal to 50,000. So your book value is 4,50,000. Sorry, net cost is 4,50,000. I have written book value. Please substitute it with net cost. Correct? Or it is also known as depreciable amount. Net cost is 4,50,000. Originally you estimated that life is of 10 years. Originally you estimated that life will be of 10 years. So that means depreciation just wait. Depreciation per year will be 50,000. Depreciation per year will be for 50,000. Total depreciation for 3 years. When I say 3 years, it means 16 and 17, 17 and 18, and 18 and 19 will be equal to 1,50,000. So that means written down value as on 31st/3/2019, or that is end of the third year or beginning of the fourth year, you can say 1/4/2019 is 5 lakh minus 150. That is equal to 3,50,000. Correct? And in this year, when you will reach at the end of the year, depreciation for 19 and 20. 19 and 20 means you are providing depreciation on 31st of March 2020. Since you have changed the method, your depreciation will be 3,50,000 into 20%. Correct? This is the situation. Depreciation per year is 50,000. Who told me? Actually, it is 45,000. I am extremely sorry. I considered 5 lakh, sorry. 450 divided by 10, 45. Anyway, concept should be clear. 1,35,000 will be total depreciation, and 135 minus 5 lakh will give me 3,65,000. Extremely sorry. Sometime it happens. So anyway, the point is that when you will provide the depreciation in 18 and 19, it should be on the written down value at the rate of 20%, that is 73,000. I think so. Correct? So not a tough question. Then we pick up question number 19. Honestly speaking, question number 19, you can do it by even yourself. Question number 19. All these are standard based question. A computer costing 60,000 is depreciated on a straight line basis, 10 years, working life and nil residual value for 3 years. The estimate or remaining useful life after 3 years were reassessed at 5 years. Calculate the depreciation as per provisions of AS 10. Anything in this question? So simple. Originally you purchased the computer for 60,000. So depreciation per year as per your original estimates will be 60,000 less residual value nil divided by 10 years. So as per your original estimate, your depreciation will be 6,000 per year, isn't it or not? As per your original estimates. Now, question states that company depreciated the asset for 3 years. So depreciation for 3 years will be how much? Depreciation for 3 years. You estimated originally life for 10 years, and for the first 3 years your depreciation will be 18,000 obviously. So book value after 3 years. After 3 years your book value will be how much? 60,000 is your original cost, correct? From there on you subtract 18,000, you get 42,000. So that is your book value after 3 years. But after 3 years you estimated that remaining useful life is only 5 years. So now in order to compute the depreciation for the 4th year, you will divide it by remaining useful life. Remaining useful life is actually 5 years. So for the next 5 years your depreciation will be depreciation for 4th year and onward. 4th year and onwards. 4th year and onwards. How much? 8,400. So 8,400 for next 4 years you will provide the depreciation. Not a tough question at all. So such questions I'm sure are going to be asked rather than what we call ledger account question or something. We pick up out of 20 and 21, both are similar question. I'm picking up question number 20. Before I pick up question number 20, I will have to explain it because it's a pretty long question. Question states that there is a company by the name of V7. Correct? This company originally purchased a machinery and the date given to you is 1/4/2008. 1/4/2008, this company purchased a machinery for rupees 15 lakhs. For 15 lakhs, it purchased a machinery. Company charged originally depreciation on a straight line basis, correct? And estimated the life 15 years and residual value of 3 lakhs. On this date, company estimated that life will be 15 years. Company estimated that life will be equal to 15 years, and company also estimated that residual value will be 3 lakh. These are original estimates. What else the question states? This question continues here. Now further the question states that at the beginning of the 4th year, see your first year will end on 31/3/2009, correct? Just to keep a good track of the question, I am explaining it in detail. You can expect such question. Then second year will end on 31st of 3 2010 because it will start on 1/4/2009. Similarly, your third year shall start from 1/4/2010 but end on 31st 3 2011. Then fourth year will start from 1/4/2011 and end on 31st of 3 2012. 31st 9, then 10, then 10 11. Okay, correct. So now question states that at the beginning of the fourth year, now as per the date, see here, at the beginning of the fourth year, remember one thing, now beginning of the fourth year, that is year 1, that is year 2, it is year 3, and this happens to be year 4. So at the beginning of the year 4 or at the end of the third year, one and same thing. In accounts, both these two dates are considered as one and same, correct? So at the beginning of the fourth year, what the company did, at the beginning of the fourth year, company revalued the machinery. A revaluation was done and upward revaluation was there. Upward revaluation of 20%. 20% of what? Whatever will be the book value at the end of third year or in the beginning of the fourth year. Because whatever value at the end of the third year will be, that will be also the book value in the beginning of the fourth year. So you'll take 20% of that. And company also re-estimated the remaining useful life. Remember, remaining is not printed, please pay attention. Remaining useful life remaining useful life is 7 years. Company estimated remaining useful life 7 years. Logically, remaining useful life should have been, because 3 years have gone by, original estimate was 15 years. So logically, after 3 years, 12 years of life should have been remaining, but we re-estimated it and we found that remaining life is not 12 years, rather 7 years. And scrap value is nil. It is also given scrap value is nil. Besides, just to confuse you, so on this date when assessment was done, this information is in front of you. Now, further the question states that the increase in net book value was credited directly to revaluation reserve. We always do that. Whatever increase takes place, we always credit it to revaluation reserve, because our entry is machinery account debit to revaluation reserve. So ultimately your machine will increase, correct, and also revaluation reserve will also increase, but it will not have any effect in the calculation. This is just to confuse you. Depreciation on a straight line later was charged to profit and loss account. We always charge any method, whatever we are following, we always charge it to profit or loss. So don't get confused, correct? It is just for the sake of confusion. At the beginning of the 8th year, now it is given. At the beginning of the 8th year, first of all, let me actually stretch it down again. Our 5th year will start from 1/4/2012, correct, and end on 31st of 3 2030. Our 6th year will start from 1/4/2013 and end on 31st 3 2014. Just to explain the point, I am doing all these things, correct? 7th year will start from 1/4/2014, end on 31st 3 2015. So your 7th year has now gone by. Remaining useful life is 7 years. Correct? Remaining useful life is 7 years, but question says that at the end of the 8th year, at the beginning of the 8th year, sorry, so 7 years have gone by, so beginning of 8th year will take place here. Beginning of 8th year, that is 1/4/2015. Beginning of 8th year or end of 7th year is one and same thing, correct? Question states that at the beginning of the 8th year, company decided to dispose this asset. Company decided to dispose it, and realizable value was estimated at rupees 2 lakh, and company estimated that its realizable value will be rupees 2 lakh. So first of all, what you will have to do in this question? Very simple. Till up to this point, because you did the reassessment in the beginning of the 4th year, so till the end of the 3rd year, first of all, you will have to find out the written down value. Then to that value, you will add the upward revaluation, and then you will compute the depreciation for the upcoming years, and then again you will compute the written down value on this date. You will compare it with the what we call disposable value to find out your loss or gain. Not very tough. So for the first 3 years, I will have to compute the depreciation because assessment is being made in the 4th year, correct? So now it will help me in easing down. So this is just a rough solution, and now we are doing it fairly. First of all, let me write the original cost. Original cost on 1/4/2008 is 15 lakhs. How much? 15 lakhs. B, depreciation per year. What will be depreciation per year? Depreciation per year will be 15 lakhs minus residual value, originally estimated residual value 3 lakhs, divided by originally estimated life 15 years. As per your original estimate, depreciation per year is 2,40,000. And we want to know depreciation till the end of the 3rd year, correct? This is the sheet which I was drawing. So now, depreciation till the end of the 3rd year. Depreciation till the end of 3rd year. And 3rd year is ending on, as we can see, as per the chart which we just made, 31/3/2011. So depreciation for 3 years will be equal to 2,40,000 into 3, isn't it? Sorry, depreciation per year is how much? Oh, depreciation per year is, actually I simply multiplied it by 3. I'm extremely sorry. Actually, it is 80,000. No problem. 80,000 into 3. Total depreciation for 3 years is 2,40,000. Correct? Total depreciation for 3 years. Actually, this is 12 lakh divided by 1580, and inside of my mind, I multiplied it by 3 also. So, anyway, depreciation per year is 80. You multiplied it by 3, you got 2,40,000. Now you can find book value as at 31/3/2011, that is end of the 3rd year, or 1/4/2011, that is beginning of the 4th year. Book value will be 15 lakhs minus 2,40,000. That will give you 12,60,000. Correct? 12,60,000. So, as per the chart, now we have reached here. Now we will add the upward revaluation. Add Upward revaluation. What is your upward revaluation? 20%. 20% of what? 12,60,000. How much it will be? 2,52,000. So 2,52,000 I will add. By adding it, what I will get? I will get revised book value. When I made the assessment, that will be equal to 15,12,000. 12,60 plus 252. Correct? Now, this 15,12,000 is the revised book value, but when you made the assessment, see here, when you made the assessment, you found the scrap value as nil at that time. G less scrap value, no scrap value, so H, it will be net revised book value. So net revised book value will be how much? Net revised book value is equal to 15,12,000. You have estimated that remaining life is still 7 years. So remaining life is 7 years. You divide it by 7. By dividing it by 7, 15,12,000 divided by 7, I get 2,16,000. This is depreciation for 4th year. Now 4th year is starting from 1/4/2000 as per our chart, 1/4/2011 ending on 31st of 3/2012. So for this year, depreciation will be 2,16,000. In fact, this was one part of the question. Now suppose if I ask you, book value as at 31st 3/2012. So you subtract this depreciation from this one, we get 12,96,000. So at the end of the 4th year, we find book value is 12,96,000. Now, less depreciation for 5th year. Now 5th year means for that is 12 and 13. Depreciation will remain 2,16,000. Correct? You subtract 2,16,000 again. Less 2,16,000. It comes to 10,80,000. This is your book value as at 31st 3/2013. Again, less depreciation for 6th year. Now for 6th year, that is 13 and 14, depreciation of course will be 2,16,000. Subtract 2,16,000, correct? From 10,80,000, we get 8,64,000. Book value after 6th year that is 31st/3/2014. Sixth year is ending on this date, right? Now we will take the seventh year, correct? Less depreciation. Sir, why you are doing so many calculations? So that you can understand in a better manner. Sorry. As you know, since last 2-3 days I am not feeling quite well. Anyway, depreciation for seventh year. Depreciation for seventh year will be, seventh year first of all here stands for 14 and 15, and it will be 2,16,000. Subtract 6,48,000. This 6,48,000 is the book value after seventh year. That is 31st/3/2015, or beginning of the eighth year, you can say 1/4/2015. On this date we decided to sell it off. So estimated realizable value which is given in the question was rupees 2 lakh. Yes. So if we will sell it for 2 lakh, then we will have to recognize the loss. Loss will be 4,48,000. So this is pretty comprehensive calculation based question. 21 is almost cousin of this question. So with that we come to the end of depreciation. So hope that it must have come up to your expectation, end of this particular chapter. And of course, in the next one, when we shall meet you, we will definitely come out with something new regarding something new. Correct? So here we go and end up this particular session. So it's a lovely good night from here in Delhi.